The QR code to mark your attendance would be displayed during the classroom in the TV. Please open up your smartphone and then select QR scanner. Please select the QR code appropriately. For example, if you are enrolled in
So can I get
select the QR code appropriately.
Can I
For
get
example,
it? I
if you
feel
are
this is
enrolled
too short.
Hello students, this is a short video guide on how to mark your daily attendance by scanning the QR code. Please follow the step-by-step guide shown in this video tutorial. The QR code to mark your attendance would be displayed during the classroom in the TV. Please open up your smartphone and then select QR scanner. Please select the QR code appropriately. For example, if you are enrolled in online classes, please choose the online QR code. If you are enrolled in offline classes, please select the face-to-face QR code. And please note that if you are an offline student and attending classes through online, you are still required to scan the face-to-face QR code even though you're attending classes through online mode. And once scanned, you will be redirected to attendance page. Over there, you are required to attend your AP ID, and your AP ID would be shared to you by our admission team during the admission process. So the AP ID would be sent to your registered email ID through email. If you don't know, please open up your email and check your inbox. You will find your AP ID over there. Once entered your AP ID, click on send OTP. OTP would be sent to your registered email ID. Once the OTP is shared to your inbox, please open up your email ID, check your inbox and enter the OTP and select the class mode you are attending and then click on mark attendance. And once clicking on submit, you are more than welcome to give your feedback and ratings on the class, or if there is any comments or additional feedback you would like to give, please give the comment and click on submit, and your attendance for that day would be marked. Thank you. Hello students, this is a short video guide on how to mark your daily attendance by scanning the QR code. Please follow the step-by-step guide shown in this video tutorial. The QR code to mark your attendance would be displayed during the classroom in the TV. Please open up your smartphone and then select QR scanner. Please select the QR code appropriately. For example, if you are enrolled in online classes, please choose the online QR code. If you are enrolled in offline classes, please select the face-to-face QR code. And please note that if you are an offline student and attending classes through online, you are still required to scan the face-to-face QR code even though you're attending classes through online mode. And once scanned, you will be redirected to attendance page. Over there, you are required to attend your AP ID, and your AP ID would be shared to you by our admission team during the admission process. So the AP ID would be sent to your registered email ID through email. If you don't know, please open up your email and check your inbox. You will find your AP ID over there. Once entered your AP ID, click on send OTP. OTP would be sent to your registered email ID. Once the OTP is shared to your inbox, please open up your email ID, check your inbox and enter the OTP and select the class mode you are attending.
Um, Hi guys, my name is Naina. Today we'll be doing a marathon for the subject F3 ACCA, okay, which is financial accounting. So in this we'll be covering everything related to F3 basically, okay. So we will not be doing sums, that is, I just want to take you through whatever theory is there, okay, and I will tell you what kind of questions they can ask you when it comes to sums, okay. It's a very simple paper, okay. This is one the most simple paper, I would like to say. You just know a few things and then you can pass this paper, okay. So I will tell you what could be tested, okay. Fine, we can start. So there are 20 chapters in financial accounting. It's the first part of next two papers, which is financial reporting and SBR, which is a professional paper, compulsory paper, okay. So once your basics are right, those two papers are going to be a piece of cake for you. So we'll start with this very simple paper, okay. Right. So first, let's start with chapter 1, Introduction to Financial Reporting. Now, what is financial reporting? Financial reporting, you're just reporting your financials to someone. That is it, right? So basic English, basic meaning, layman's terms, this is how it goes, right? Now, what do we do in financial reporting? Basically, why we do this is so that the stakeholders, who are stakeholders, anybody who is associated to our business, let it be direct, let it be indirect, anything, okay, anybody who is associated to our business becomes a stakeholder, right? Now, when we're talking about stakeholders, in we have three types which we'll be learning about, okay, but that's not that very important when it comes to FR, but still we'll go FA, but still we'll go through it once. Right. So now financial reporting is to provide stakeholders with useful financial information. What are these useful financial information that we're talking about here? Anything that helps us make a decision. Okay. So basically, any information is useful if it helps us in making a decision. Okay, decision on what could be multiple things, right? So stakeholders could be shareholders, they could be employees, they could be management, they could be customers, suppliers, competitors, many people, okay. We'll be looking at the users of financial statements for that, right? So now, why do these people want information and what kind of information do these people want is a question, right? So we will be dealing with users like investors, very important, okay. Investors are going to be one of the major people who are going to influence our decisions, right? Now coming to the next one, employees, very simple guys, you're working in a company, right? You would want to know if the company is performing good or bad, like if it's on the verge of bankruptcy, good for you to like change the company, shift your rules, run to a better company, a better job, as in when you have the time, okay. But if you do not know anything about it and final moment they come and tell you, no, we are bankrupt, you guys leave, then it's going to be horrible for everybody who's working in the company, right? So you need to be aware about your surroundings. That's why these people need information about the financial statements. Got it? Next, lenders. Lenders are the people who give us money, who we borrow from, okay. Why do they want to know about our financials? Because they need the assurity that we will eventually pay them back, okay. If we cannot pay them back, they will try to take money from us right now. So the moment they get a sniff of something happening, they are going to take their money back. Got it? So that's why lenders need to understand our financials as well. Government, why? Policy making, taxation. What is policy making? If we are let's say there's competition act, right? So if we are not we have a monopoly and government doesn't want that, they can change the policy to make it against us, and then we'll have to do something that will satisfy the government, right? So policy making, taxation, very important. This is one of the major sources of income for the government, right? So that's why they do not want anybody messing with the tax. Coming to suppliers, why? Because they want us to pay them back. So similar to lenders, but here they supplied us something and we need to pay back for it. If we do not do it, then their business won't run, right? So just the opposite of that is customers, who will want supplies from us. For example, if we are manufacturing something rare, okay, and nobody other than us in the market is manufacturing that, the customers will be very sad if we go bankrupt and if we are not in business anymore, because we are the only people who can supply to them, correct? So that could be one reason why customers want to know about our financials, along with, let's say, if they give you a good quality, if you're etc. There are multiple things we'll look at. Public is basically not directly connected to us. They're indirectly connected to us. How? Let's say, are we fulfilling any CSR responsibilities? Are we causing any pollution to the environment? Anything? These things they look at. Got it? These are the uses of financial statements, right? Now we'll be learning about different types of accounting. One is financial, one is management. What is financial accounting and what is management accounting? You need to understand this difference. Okay, you could be tested. A small MCQ could come based on this. So what will you tell? Financial accounting is something for the external stakeholders, whereas management accounting is for the management, who are the internal stakeholders. Got it? Now, both financial and management gives us the same information. And then if it gives us the same information, why are we calling it two different names? Correct? Now, this goes to external stakeholders. So whenever we are sending information to external stakeholders, we are talking about the same company here. Same company. But why are we giving separate information to external stakeholders and why are we giving different information to internal stakeholders? That's the question, right? So for external stakeholders, who are investors, lenders, government, suppliers, competitors as well, it goes under financial accounting, which is the statement which will be audited. Okay. Management accounting information will not go into anyone's hand other than the management. Okay, because this is the thing which is very detailed, very important, very confidential, and nobody should get a hint that we have this in our hands because they will try to take it from us. Okay, so this is confidential. We do not want confidential information to go to competitors' hand. Correct? So management accounting is detailed. Okay, and it is about forward looking information. Like you look at the information and then you will decide, what should we do with this? Like that. Okay, whereas financial accounting is about the historical information. Like, yeah, we had so many assets, so many liabilities, what did we do with that, where did we spend our money, where did we get money from, how much tax we paid. All this extra information is financial accounting. Got it? Right. So that's the difference between financial accounting and management accounting. Depending on who's listening, we make the information. Next part of the chapter is types of business structure. Now, there are three types that we will be learning in FA. Okay, sole trader, partnership, and limited liability company. Now, this is a very simple topic which we would have learned in 10th, 11th, and 12th. And if you all are in degree, then you would have learned it there as well. Okay, so there's no much explaining that we can take with this. So we'll just skim through it. Okay, so we can focus a little more on important topics later. Right, ownership, sole trader, very obvious answer. One person is the owner. Partnership, two or more people. LLC, who are the owners? Shareholders are the owners. Okay, coming to control, owner controls it, partners control it. Here, it is managed by directors. Ownership and management are two separate things here. Okay. Capital, where is the money coming from to do business here? Here, personal savings, loans, borrowing from family, anywhere. Okay. Partnership, same. From both the partners, we pool in the money. Limited liability company, we take it through shares, which gives us shareholders who are the owners, or from borrowings. Borrowings comes from loans, or again, financial intermediaries, anybody. Okay, got it? Right. Next is liability. Here in sole trader, the owner has unlimited liability. Okay. So what is the meaning of unlimited liability? Let's say he puts his money inside in the business, right? So now what happens is, if the business, God forbid that happens, but if the business goes under the waters, then all his personal assets are at risk. What is the meaning of that? His car, his house, whatever properties under his name can be seized by whoever he owes the money to. Okay, so here the business and the owner is one person, same. Okay, business and the owner is one person. But when it comes to limited liability company, here the shareholders who invest their money is, their liability is limited. What is the meaning of that? Now we'll invest in a company. The only loss that we have is, okay, let's say I invested 1 million in ArivuPro. God forbid something happens there. Okay, the only loss that I have is 1 million. Correct? Because they can't come for my house, for my property, for my jewelry, for my whatever assets that I have. They cannot come and snatch it from me just because I'm investing in the company. Correct? So that is limited liability company. Okay. That's why the name itself says limited liability. Only the amount that I have invested, that is what I will be liable for. Legal status. What is legal status? Sole trader and partners, the company, the owner and the company is the same thing. So that's why it's not a separate legal entity, not a separate legal entity. This is a separate legal entity from its owners. Got it? Regulatory requirement, very few regulatory requirements. That's why people prefer, if there's one person opening the company, very few regulatory requirements. He can start the company, he can open his house itself as a shop, and he can start the company. Okay, sole proprietorship. But when it comes to partnership, two people have to do it, right? So there will be no trust amongst people like that. That's why they'll have to make a partnership deed, and then they'll have to start the business. So a little bit of regulations there. Okay. Coming to limited liability company, the regulatory requirements are very high because it is listed on the stock exchange, because people are giving their money to the company to invest. So that's why they must comply with the laws, with statutory records, with reports, with everything. They need to comply. Okay, they have to be open like a window, a transparent window. Everybody needs to see through what's happening there. Okay. Profit distribution, owners have all the profit. Here it is shared according to whatever partnership deed says. And here distribution as dividends. Distributed as dividends or retained for growth. This is what happens in limited liability company. Got it? Coming to continuity, if one shareholder dies, the company will still continue. They will not go and even attend this person's funeral. That is how unbothered they are by one person dying. Okay, so it will still continue regardless of how many people are the owners, how many there's that, right? Perpetual succession, nobody cares. That is what it means. Coming to partnership, if one person dies, then they dissolve that person's contract and then they restart the partnership. That's all that happens. Here this person dies, nobody can continue the business anymore because only one person is dealing with it. Coming to taxation, personal income, similar to business taxes, because owner and the business are the same entity. Okay, no separate entity. Partners are taxed individually. Again, there is a profit that they make from the business and their personal income. Both of them, they are taxed together. They are not separately taxed in the business. Here, company pays their own tax, shareholder pays their own tax, but shareholder also pays tax for some dividend if they are getting any. Okay, so these are the forms of business. We have partnership, sole trader, and limited liability company. Just in short, to look at it once. Okay, for sole trader, only one person owns it. He has full control of the company. At the same time, the risk is he has unlimited liability. Okay, partnership, shared ownership, pooled resources, and joint liability. Limited liability company, separate legal entity. This is a very important term. Limited liability. That's one good thing for us there. Got it? Okay, here comes a little important part, conceptual framework. Okay, so conceptual framework, and there's something called regulatory framework also. Okay, so now under conceptual and regulatory framework, we'll do one thing. Okay, conceptual framework are the principles that help us go in the right direction. Okay, regulatory framework are the rules or laws that we need to follow. Okay, got it? So if you do not comply with conceptual framework, no problem, it's okay. Yeah, it's the easy way that they found for you. If you don't want to do it, your wish, no problem, nobody's gonna arrest you. But if we are looking at regulatory framework, these are the laws and rules. Okay, if you do not follow that, you are asking for trouble at this point. Okay, so we shouldn't be doing all that, right? So when we look at conceptual framework, I always like giving this example whenever I'm teaching conceptual and regulatory framework of going on a road trip. So whenever we are going on a road trip, okay, so we have the Google Maps, let's say GPS, that guides us on the way to go. So this is how the way is. It disappeared. This is how the way is. Okay, but at the same time you can reach it in this way also, this way also. Okay, this is how it is. One second. Right, now you can either take this route, or this route to reach it. Okay, now what conceptual framework does is, it will tell you you can take this route, this is the shortest route for you. Okay, but then you will be like, who are you to tell me all this? We are not going to listen to you. Okay, then you will be like, no, I will take this route because I want to enjoy the scenery. Now obviously you went against what conceptual framework told you, but nobody's gonna do anything to you, right? That's one scenario. If we are looking at the second one, which is regulatory framework, that is like traffic laws. Okay, what is the meaning of this? Let's say this is the straight way to go. Okay, this one and this one is one way. Okay, but then you're like, no, I don't care, I want to take this route, I will take this route, I don't care whether it is one way or two ways. Okay, and you go this way. You are asking for trouble at this point, guys, because we can only go this way is what the traffic rule says. But then you're like, never mind, I don't care, I just listen to myself, and then you go this way. Okay, you know what will happen? You will go to jail if the people catch you. Okay, but then if you can like give them some money, anyway, it's loss for you. Okay, that is what I'm talking about. Right. So that's what conceptual framework and regulatory framework means. Conceptual framework, principles. Regulatory framework, rules and laws. Got it? Okay. Fine. Let's continue then. Okay. Why do we need a conceptual framework? It's a foundation for accounting standards. How are we going to start making foundation without knowing the basic principles? Correct? So it assists IASB. Now, what is IASB? We'll come to that part a little later. Okay, just understand these are the people who make standards. IASB in setting consistent and logical standards. What logical standards are they making? That we do not know because IASB is responsible for it. Okay. Provides guidance where standards are silent. So sometimes, so obviously we have standards, correct? There will be new standards coming in each interval. We cannot bring in all the possible permutations and combinations of standards that company could have to go through, right? So that's why what we do is, as in when we have a problem, we'll understand, this one should have required a standard. For example, let's say we started the company. Okay, we didn't know that a company could buy another company. Now for that we had to create a new standard, that is consolidation. Correct? So now only when a problem like that happens, only when a problem like that occurs, you will know that, oh, we are missing out on a standard, we need to go back and get the standard in place. Okay, so that is what happens, right? Now we do not know what it is, so at that time we just look at the conceptual framework. They'll give you the principles. They'll be like, if you do this, that will be right, if you do that, that will be wrong. Okay, then you'll automatically know. It's like the two angel and devil sitting on your shoulder. You will know what is right and what is wrong, but you will still choose to do it, and then we cannot help it. Okay, so when standards are silent, we run to the conceptual framework. Okay, now whenever we're talking about conceptual framework, we always have to deal with qualitative characteristics of financial information. Now, any information is good information only if it complies with these two qualitative characteristics. One is the fundamental qualitative characteristics and one is the enhancing qualitative characteristics. Fundamental qualitative characteristics are relevance and faithful representation. We can remember this by using the acronym FR. Okay, but when we come to enhancing qualitative characteristics, they have four components within itself: comparability, verifiability, timeliness, and understandability. Here you can remember VCUT. Got it? So this is the way you can understand qualitative characteristics. For example, they will ask you in the question which one is not an enhancing qualitative characteristics. For example, let me say they're asking which is not. Okay, and options are comparability, relevance, verifiability, timeliness. Which one is not? We'll just look at our VCUT. VCUT. VCT. No R. Cancel. This is how you look at MCQs. They'll ask you very simple MCQs whenever we're looking at conceptual framework. Got it, guys? So relevance is capable of influencing the decision of investors. That is relevant information. For example, if we are going to a toy store, okay, we cannot come and tell somebody, if they come and tell us that the bookstore is closed, we will not be bothered in the least, because what do we want? Toys. We do not want books. We do not care about that information. We will filter it out from our mind. Correct? That is relevance. Whenever we are looking at faithful representation, what is the meaning of this? We do not need bias. Okay, so if let's say we're talking about a favorite cricketer. Okay, for example, a cricketer. Now, there's one person who likes some cricketer. Okay, and then you don't like this person, the cricketer. Okay, so whenever this your friend is talking about the cricketer, you will be like, yeah, whatever, I don't care, right? But then even though this person will be trying to give in the information, trying to make you like this cricketer, you will not be bothered in the least. So that is, you are showing bias because you don't like the person. So whatever this person does, you will not be bothered about it. That is faithful representation. What you're doing is not faithful representation. You're biased against this person. If you would have gone the straight way and you'll be like, oh, this person did this, and then clearly taken it in your mind, then it would have been faithful representation. Coming to enhancing qualitative characteristics, we have comparability. Investors want to compare the data. That's when they will understand where to invest their money in. Okay, just because they have two companies there and they like the name, they're not investing there. They'll have to compare the data. Okay, and if the data is not good, that's when they will try to look into something better, right? So comparability is a very, very important factor whenever we're looking at qualitative characteristics, right? Verifiability, independent verification should be possible. Now, the company will tell we are doing this, we are doing that. For example, there was this Volkswagen. I hope you know this company. Okay, so they kept telling earlier, okay, before the sustainability standards came out, they told our cars are not polluting the environment at all because our CO2 emission is in this level. This level is what they told. Now nobody could verify that, right? They're like, okay, CO2 is look very good, what an amazing company is what they thought. Okay, but then when the truth came out, you can go read about it. It's called Dieselgate scandal. So when the truth came out, we got to know that they specifically designed a software which shows that CO2 is less, but it is not how it works. Okay, so even though it is not the truth, they still made a software to make it look like the truth. Okay, so verifiability is important. If you're telling something, prove the point that you can verify it. Timeliness. Timeliness is something like this. You want to make a decision today. If you get the information to that after 2 weeks, will you be bothered about that information? You're like, you'll get the information and then you'll be like, what is this information? Then they'll be like, you asked for this 2 weeks ago. Then we will throw the information and we'll come out because we do not care about that information anymore at this point. Understandability, final one, we will not be using technical jargons. If a person has limited business knowledge, that person also should be able to understand whatever our standard says, whatever our statement says, basically. Got it? That is understandability. No jargons, no hi-fi English. We will use normal, proper terms. Okay, this is important. We'll have to deal with these 5 elements. Okay, financial statements has 5 elements. We have 5 financial statements also. We'll look at that a little later. But for now, just know that we have 5 elements of financial statements: assets, liabilities, equity, income, and expenses. Got it? Now, what is assets? Assets is just, you need to remember these words. I'll tell you which one. We'll use a better color. Red, since RCB won yesterday. Okay, assets. Present economic resource, very, very important word, control due to past events. Okay. For liabilities, present obligations is what you need to remember. For equity, this is residual interest. What is the meaning of residual interest? Assets minus liability gives you equity. Okay. Income is increase in economic benefits. Okay. Expenses, decrease in economic benefits. That's it. Okay. Now, income and expense comes in SOPL, profit and loss account is what you might have heard, but we'll be looking at statement of profit or loss. And the remaining 3 comes in SOFP, statement of financial position, in common terms, balance sheet is what we'll be looking at. Got it? You need to know which is debit side, which is credit side, which we'll be learning in the next few chapters. Okay, with this, we are done with the first chapter. I hope you have no doubts with the first chapter. Okay. Second chapter, this is a very short chapter. It totally focuses on regulatory framework. Okay, out of which we've already covered up what is regulatory framework and conceptual framework. So we can just remember these highlighted points here with a different color this time. Okay, regulatory framework. What should we understand? Legally binding rules here, theoretical guides, principles you need to remember. And after this part, we are just talking about what is it? Faithful representation, comparability, etc. Okay. Coming to regulatory framework, here they will tell these include IFRS, Companies Act, statutory requirements. See, if you breach IFRS, nobody will look at your statement. So it's important for you to look at that. That's why this comes under regulatory framework. Okay. Next, compliance is mandatory. Like I said, you do not have an option. Okay, you have to comply with it. That's it. Okay, this is important. Let's go through this. Regulatory framework. Now, like I said, regulatory framework are rules and rules you need to comply with, right? Now, there should be people who deal with whether you comply with the rules or not. That is the IFRS Foundation. Okay, IFRS Foundation is the umbrella body which takes ISB, ISSB, IFRS IC, and IFRS AC into consideration. Okay. Now, what is regulatory framework? Regulatory framework, again and again, I'm telling you, it is compliance mandatory. You remember these words: law, regulation. Okay. So whenever we talk about IFRS Foundation, you need to know this is the head, this is the umbrella body, the highest superior authority, supervisory body is what you can remember. Okay. Now these people do not directly make the standards. Okay. They are the head, correct? But they do not directly make the standards. What do they do then? They make sure that whoever is making the standards is doing a good job with making the standards. That's IFRS Foundation. Okay. For example, when we are talking about cricket again, let's see BCCI. They make the rules. They make certain new rules whenever we look at IPL, correct? So whenever they're doing that, as soon as a player does something opposite to it, they are not the ones running and going to the field and telling no, stop. They're not doing that. Okay, who is doing that? The umpires. Okay. So similarly, IFRS Foundation is not the one who's directly executing things, but then they are going to be the head. They will make sure that everything is going right and according to the rules and regulations. Got it? That's IFRS Foundation. So they deal with everything else. They deal with the funding of the organization. They deal with everything. Basically, whatever is needed in the whole IFRS body, they take care of it. Now, under IFRS, we have something called IASB. What is IASB? IASB is the standard setting body. Okay, International Accounting Standards Board. IASB is the body that sets standards. Similarly, ISSB also sets standards, but only environmental standards. Now, this wasn't there until recently. Okay, but recently it came into existence. I don't know why that circle's not coming. Okay, so until recently it wasn't there. We did not care about these environmental laws. For example, remember I told you about the Volkswagen one? Yeah, till then it wasn't there, and then they realized that people are just faking environmental contribution at this point. Might as well start something that will show that they are doing something true or false. Okay, so that's why we have ISSB, International Sustainability Standards Board. Okay, so that is ISSB. Next is IFRS IC and IFRS AC. IFRS is International Financial Reporting Standards. Okay, IC is the Interpretations Committee. Okay, and AC is Advisory Council. Now, standard setting body, whenever we look at that, we are called the standard setters. That's it. So what do? These are the real powerhouse. They are like the right hand for IFRS. Okay, so what do? They make accounting rule book. Okay, how do they make accounting rule book? They consult with people who are using it, like stakeholders. They consult with auditors, with businessmen, with whoever is relevant. Basically, they go and consult with everyone, and then they come back and then make standards about that. Okay, now if these people would follow different accounting policies, okay, what would happen? A investor could never compare two companies in one go. Let's say an investor wants to compare Tata with McDonald's. How will you do that? If both of them are using different accounting standards, we cannot do that, correct? So that's why to do that itself, we need standards. And who are setting up these standards? IASB, International Accounting Standards Board. International Accounting Standards Board. Okay, right. Next, ISSB, like I said, This is something which also sets standards, but then they deal with only environmental standards. There are very few, because like I said, it started recently. Okay, whenever you're looking at let me show you. A green Hulk, you should always remember ISSP, because we are dealing with green. Okay, so this is the person who is an environmental watchdog, you can say. Got it? That is ISSP. Next, IFRS IC, Interpretation Council, is whenever there is one second. Yeah, this is like a hotline. Now you do not know, you purchase something from Amazon, right? You do not know how to use it. Then what do? You call the customer care and you'll be like, I bought this, but like, how do I use it? I just bought it because I had too much money. Now I do not know how to use it. Can you help me? Okay, something like that you'll do, and there's always somebody to help you. That is like the hotline. This is interpretations committee. For example, there's a standard and you don't know how to use the standard. Who do you run and go to? The interpretations committee. These people will simplify the standard for you and then help you understand how you apply this in your particular scenario. Got it? Next, we are dealing with IFRS AC, which is Advisory Council. What is the Advisory Council? This is the person who thinks, basically thinker is what you can name him. Okay, so this person, what he does is he or she should stay informed about the industry trends. Okay, so as soon as IASB publishes a standard, he goes down. Okay, goes down on the, like, the market basically, and then he will think, see, this is the standard that we have published. Are you happy with it? He will ask all the relevant stakeholders there. Okay, whoever is affected by this, he will ask them. Okay, are you fine with this? Is this standard okay for you? Is this standard helping you out? Do you require any new standard, etc.? Okay, this is the person who deals with the actual stakeholders. Okay, so as soon as he gets some feedback, he comes running back to Mr. IASB, and then he'll be like, see, you did all this, but then they are not happy, they need something else, and then IASB will go into thinking, and then they'll make a new standard. This is how it goes, like a cycle. Got it? I hope you understood what is the regulatory framework and who are the people, who are the bodies that are there in regulatory framework. Understood, guys? Right. Okay. Right. Corporate governance, very simple. It's just basic rules and regulations. Be ethical, reduce your risk, etc. So firstly, there's this person called CEO of the company, and there's a person called chairman. Okay. These two people should never be the same thing. These two people should never be the same person. Okay, that's one thing. Effective internal controls you should have. The company should be transparent. You should be ethical in your business, etc. Just basic things. Now, what is agency theory? Now, there are two people. Okay, one is the shareholder, who is also the principal. Okay, and one is the management or board of director, who is also the agent. Okay, agents always act on behalf of the principal. Got it? Now, it is shareholders' property, but agents are taking care of it. It is shareholders' property, but management is taking care of it. Okay, now their main duty should be to maximize these people's wealth, because they're taking care of their property, right? But sometimes what happens, they get greedy. After all, they're all human. Yeah, Mohan, you can ask me whatever doubt you have. Okay, management, agent, and we'll clarify it as before the class gets over. We'll clarify the doubt. Okay, right. So shareholders is the principal and management is the agent. Management has to take care of shareholders' resource, their property or whatever. So shareholder is the owner of the company. Management is appointed to take care of the shareholders' company. But sometimes what they do is they get a little greedy, and then what they do is they try to do something on their benefit. Okay, something that harms the shareholders' wealth, but they still go ahead and do it. Okay, they take the risk. That is agency problem. That is the problem that they have. Okay, agency theory is just this person is the principal and this person is the agent. Okay, they have a relationship like a shareholder, like a principal and agent, but now they have a problem of agency problem. How do we mitigate that problem? We need to make sure that both of their goals align. How can you do that? Management needs to understand that if principal gets a profit, he'll also get a profit. If something like that happens, he'll try to make the principal get a profit. Okay, he will work for their benefit then. So that's how you mitigate. Let's see how. To mitigate agency problems, the principal can implement incentive structure. What is the meaning of incentive structure? Something that gives the board of directors incentives based on whatever they're doing. Okay. Next, regular monitoring and audits can help ensure accountability. Independent directors and strong corporate see, if you have NEDs, independent directors, if you have good corporate governance, that reduces so many biased decisions. Then the director will itself be scared. They'll be like, huh, if they get to know I'm doing this, I'll be in big problem, is what they'll think. And it'll, reduce their fear, increase their fear a little more. And then they'll be like, okay, maybe I shouldn't do this. But if they do not have this corporate governance, if they do not have independent directors, they'll be like, who's going to catch us? We're the final bosses anyway. Okay, so that's not how you mitigate it. You need to have corporate governance, you need to have independent decision directors, you need to make sure that disclosures are mandatory and transparent. Okay, right. Conflict of interest. What is conflict of interest? Under agency theory, a principal who is a shareholder appoints an agent who is the manager to act on their behalf. The expectation is that agent will act in the best interest of principal. But then there's always a conflict of interest in between. The agent's personal interest clashes with duty to the principal. The agent is tempted to act in their own interest. That's it. That is conflict of interest. Okay. With this, the second chapter is over. It's not a very big chapter, guys. It's a very simple chapter, if I'm being honest, because there could be nothing tested more than conceptual framework and regulatory framework, or the IFRS systems and structures, what we just looked at this part. Okay, more than this they cannot ask anything from chapter 2. Okay, let's go to the next chapter then. Double entry bookkeeping, chapter number 3. Okay, right. So now under this we will learn how to do double entry bookkeeping. This is a very tiny chapter, as you can see, except for we will spend a little more time on these business documentations, because I am pretty sure you're gonna get one question at least from business documentation. Okay, so we'll go through that once. Right, duality concept. So every transaction that you have will always have two entries. Okay, will affect two accounts basically. Okay, so if there is assets, you know how in balance sheet assets is always equal to liability plus equity. This is what we follow. Okay, now this is the most important thing you can know for all the journal entries, for everything. This is the most important thing. Okay, if you know this, you can create journal entries very easily. Okay, we have debit, assets and expenses. We have credit, liability, income and capital. Capital is also known as equity. Got it? So just remember debit AE, credit LIC. This is how I remembered when I was studying, and it was very helpful for me because I didn't like journal. I wasn't a journal person as such. Okay, but once I started learning it in this way, I was like, huh, what journals? So simple is what I thought. Okay. Right, so key books and records. So we have journals, ledgers, cash books, petty cash books. We have multiple books. That's okay, right? So now in this chapter, all we care about is this part and business documentation. Okay, right. So now business documentation. Now this is a very fun topic if you can understand it through the help of a story. Okay, without that, it's going to be very hard for you to understand this. So just give me like what, 3-4 minutes. If you properly concentrate these 3-4 minutes, you will understand all these documents. Okay, we'll be dealing with these documents: purchase requisition, quotation, purchase order, GD and GRN, purchase invoice, supplier statement and remittance advice, receipts, debit note and credit note. In just, okay, maximum 5 minutes. Okay, within 5 minutes, if you're listening to it, I can give the assurance that you will understand these documents. Okay, but then we need to go through an example, because I always like teaching with examples. Okay, we have two people. I taught the class also with this example, so if my students are watching, they will know this example. Okay, let's start with this, and there are multiple other people. Okay, let me give a different hairstyle. This person journals is okay, I think good enough. Okay, so we have a company called Ryan Bakery. Okay, now their main dish is a bread. Now for bread we need flour. Okay, without flour, no bread, no customers. Okay, now what Ryan needs? Flour. Okay, now what he does, okay, let me just write flour mills here. Okay, now the bread is not able to be made because there is no flour. Ryan's assistant comes running to Ryan. He'll be like, Ryan, we do not have bread with us. Okay, we cannot make bread because we do not have enough flour with us. Do something about it. And then Ryan will be like, oh, why are you acting so stupid? Just order some flour then. And then the assistant will be like, okay, wait, let me write that. Then the assistant will be like, okay, I guess I will order now. How should I order? And then Ryan will be like, okay, do one thing. First, just write down in a sheet of paper what and all you need and why you need it. And then I'll sign it and then we can just go ahead with it. Okay. So now the assistant comes forward. He's like, okay, fine. I'll write in the sheet of paper. What do we need? We need flour. Okay. Why do we need it? To make bread. Okay. And then we'll also write how much does it possible cost, how much it could be. We'll just write all that, just regular estimate. Okay, and then he will take the sheet to Ryan, and then Ryan will be like, okay, this looks fine. Okay, we can order it. And then Ryan signs it. There's a signature. Okay, now with this purchase requisition, this is the purchase requisition. Got it? Purchase requisition is when somebody else, okay, not the owner, somebody else comes to the owner telling so and so goods are completed, we need to buy more, please sign the sheet for it. Okay, so now after reviewing it, the owner approves it. Got it? Now as soon as this approval happens, what we need to do is we need to figure out from which customer which supplier we are gonna get this. So these three are gonna be our suppliers. Let's say we do not care about the other two for now, just for now. Okay, now we looked at each one of them and then we're like, okay, fine guys, you all can send us your quotation. So all three of them send the quotation to Ryan's company. Okay, and they'll be like, okay, fine, see, this is how it is. What is quotation now? Quotation, in this sheet they will tell 1 bag of flour, the cost of each flour, estimated delivery days. All such information, they'll take it and they will put it in the quotation and they will submit it to the company, submit it to Ryan's company basically. Okay, so now that Ryan knows how long it's gonna take, how much it's gonna cost, he can make sure that he takes the best deal out of these three. Okay, he'll be like, okay, fine, now we do not care about the two of you anymore, you can go away. We are only gonna deal with Mr. Reynolds. Okay, so now Reynolds quotation is fine, he's happy with his bag. Okay, he's happy with whatever he's doing, right? He's happy with the delivery days, he's happy with the price, etc. And then he's like, okay, fine, we can go ahead with Reynolds, is what Ryan says. Now what we need to do, we just can't decide, okay, Reynolds, and then keep quiet. We need to send an official order requesting Reynolds to give those things. Okay, now for example, let's say we want 100 bags of flour. Okay, and the price per bag is already mentioned in the quotation, but we'll still mention it here. Okay, so price per bag is 500. Okay, and then the delivery address we'll mention. Delivery time they've already told, so delivery address, Ryan Bakery, blah blah blah, whatever the address is. Okay, and then he also mentioned here payment terms, like how many days credit do they want. Let's say 30 days. Everything is mentioned, everybody is happy, that is the purchase order. So this official data, what happens is they take the data and they send it to Reynolds. So Ryan will send it to Reynolds. Got it? With this, Reynolds will have an official inquiry. He's like, okay, fine, now we can start making the order. Got it? With this order, Reynolds will confirm the deal and then everybody is happy. Order can start being processed. Okay, next scene is on the delivery date. Okay, now the truck is coming in with whatever goods they asked for, 100 bags of bread. Okay, they'll come to the warehouse, they'll keep it there, and then this truck person, okay, he's riding a truck. Okay, he's riding a truck. This truck person comes in and then he has a sheet, and this is Ryan's go down. Okay, now what does the truck person do? He gets a listing. So now this person, truck person, gives a sheet to Ryan, sorry. He gives the sheet to Ryan. Okay, truck person who is being sent from Reynolds gives the sheet to Ryan. Got it? So far, is it clear? Now, what does the list say? What are the items that they have delivered is what will be mentioned in the sheet. Bread. Okay, 100 bread, so much is what they will mention there. Now, Ryan will stand there and he'll be like, 100 bags of bread, is it even there? He will make the proper check there. Got it? So now what happens is, whatever this sheet is, Ryan will compare it with purchase order. What are we comparing? This particular sheet with the purchase order to see whatever we have ordered, have we received it? To check that, he will compare it. That is called the goods dispatched note. Got it? Next. So that is the goods dispatched note. Next is goods received note. Now what happens? Ryan will check everything. Yes, goods dispatched note and purchase order match. Now we can confirm that we have received everything. So goods received note is, Ryan will make a note. In that note, he will confirm 100 breads, pack of breads received. Everything is in good condition. That's it. That is goods received note. This is just a confirmation of us receiving the good. Okay, now that's it. That's good. Now we can start using the same goods received note in our stock. Okay, now with that we can start making the bread. Got it? Right. Next scene is the purchase invoice. What is purchase invoice? Now Ryan's like, okay, fine, I like the goods. Okay, no problem. Then Reynolds will be like, oh, okay, so you like the goods, now you can make the payments, right? Not immediately. They told 30 days. So we need to give them 30 days, correct? Ryan also knows that. Reynolds also knows that. So what he will do is, in a sheet of paper again, what he will mention? He will mention the invoice. What is invoice? In that it will be written, okay, you need to pay us 100 bags into, how much was per bag? I forgot. 500. 100 into 500, which is $50,000 is amount due. He will write there. And then payment terms was how many? 30 days, correct? So he will write this one plus this one. Got it? This is purchase invoice. Now, this is nothing but a request for payment. Got it, guys? Right. Now, after a request for payment is sent to Mr. Ryan, who is the owner of the company, what will he do after a week or something? Let's say Reynolds again. So now he has already sent the payment invoice. He has nothing left to do. So he's like, okay, fine, the month is, it's going to be the month end. Let me again remind him that he needs to pay me. So in the supplier statement, whatever purchases has happened. Now here we have only spoken about bread, but then maybe there could be more purchases, right? So there could be a total net amount due. All the purchases in that particular month, everything they will write it in the supplier statement, and he sends it. Who sends it? Reynolds sends it to Ryan. Got it? That is the supplier statement. Okay, we will be learning in chapter number 13 about supplier statement reconciliation. So sometimes what happens is, in this statement there could be some mistake. Okay, we need to correct it, basically that. So we'll be learning about that in reconciliation. The next few chapters we'll get that particular topic. Okay, that is supplier statement. Next is remittance advice. What is the meaning of remittance advice? Ryan, finally he's fed up and he's like, okay, fine, oh my god, I'll pay you the money. So Ryan will make the payment, okay, and he sends this remittance advice to Reynolds. In that remittance advice, what and all does he mention? The remittance number, the invoice number, this one, invoice number, purchase invoice number, to tell, in relation to this, I'm making the payment. Invoice number will be there, and then payment method will be there. All that will be written in one particular sheet that is called the remittance advice. Okay, so Ryan, after he's fed up, he'll make the payment, and when he's making the payment, he will mention all this information in this sheet called remittance advice. Was this fine? Next, we have receipts. What is receipt now? Receipt is Ryan has already sent the money. Reynolds received the money. So after he has received the money, he'll be like, okay, this is your confirmation, confirmed, paid, like this. He will write it in a sheet and he'll send it back. Got it? And then now this is one scenario completely done. Now let's say what happens is Ryan did not like the goods. Okay, let's say in this scenario everything went well, bread was good, okay, everything is fine. But just in case the bread was spoiled, okay, Ryan is not going to take it. He's going to be mad. He's like, I'm paying for it. How can I not get the good product here? Right? So now in one sheet, what he'll write, I want to return the goods. Okay. He got to know that the goods are spoiled. So he's like, I do not want this anymore. I want to return the goods. So now let's say all the, all the 100 bags is too much. So let's say 10 bags are spoiled. So now 10 bags into 500 is how much? 5,000. So 5,000 he needs to get a refund and the goods need to go from here, correct? So for that he sends a note. That's called the debit note. Got it? To return the goods. Now, what does Reynolds do? Reynolds is like, okay, I'm so sorry about this. We did not know about this. What are we gonna do now? We will take the goods back and then we'll send you the refund. I'm very sorry, Hilda. And to confirm that, okay, return pickup confirmed and refund confirmed, he will issue a credit note. Got it? So these are the only documents you need to be bothered and care about: purchase requisition, quotation, purchase order, GDN, GRN, purchase invoice, supplier statement, remittance advice, receipts, debit note, and credit note. Now it sounds like too many documents, but then once you understood the scenario, it was fine for you, right? If you can understand it that way, it is very nice, simple topic this is, guys. Okay, do you have any doubts in this? You can take a picture of this and read it once if you want to, that is. Okay. And this much. I will focus my time a little more on topics which could be tested in your exam. So if I'm skipping through the other things, you cannot skip, guys. You will at least get 2 to 4 marks out of it. So go through it once, okay? Accounting systems. An accounting system will help business keep track of the money. This is basically, instead of writing it in a piece of paper, you're using software to write it. Okay. So now we have inputs, processes, and outputs. So inputs get into processes and becomes output. So in this scenario, what we're talking about is inputs like bills, journals, all this in the end becomes financial statements, correct? Trial balance, financial statements, all this become output. In between, how are they churned together? Using ledgers, journals, etc. That's processes. Got it? Now cloud accounting, this is very simple. We'll just skim through it once. So cloud accounting means using the internet to access your cloud from anywhere. You know what is cloud, right? Whenever you're using Instagram, you're uploading the photo somewhere, right? So that is cloud software. Okay. In Instagram, cloud software. Google Photos, cloud software. Everywhere it is stored somewhere. You'll give in your Gmail account or whatever, it will get stored somewhere, right? You don't have it in your device, but somewhere in the cloud it is still there. What are the advantages and what are the disadvantages? Could be a tested question just for 2 marks maximum. Okay. Advantages: no expensive computers or software needed. We just need a software. We just need this small, we need to probably pay a little more extra to get more storage, but everybody gets a free level. Disadvantage: depends on the internet and provider. Okay. If the provider, internet provider, and the provider of the software is not good, then we cannot be satisfied with it. You can add or remove users easily. Many people can work on it at the same time. Safe in case your computer breaks. If your computer breaks down, okay, and no work is done for you, then you'll be very sad about it. So that's why what you will do, you can do is put it in the cloud and use some other computer, use the same data, you can get it. Might not work during server problems and risk of hacking if not secured. Okay. Next is chapter 4. Chapter 4 is a very simple chapter again. So the next few chapters are going to be small and tiny and we can finish it off early, but the last few chapters will focus a little more on. Okay, recording transactions and events. So here we'll learn how to record whatever transactions are being incurred. Okay. Now, Credit versus cash transactions. So whenever you know what is credit versus cash transactions, right? Cash is immediate payment, credit is payment is deferred. You will eventually have to pay, but then a little later. Okay, you have the right to like defer, delay your payment as much as you can according to the supplier's wish, obviously. So these are the small journal entries that we need to remember whenever we're looking at sales versus purchase transactions. For example, if it is a sales transaction we're looking at, okay, let me teach you through that debit AE and credit LIC rule. Okay, so sales debit receivables. Receivables is an asset. Okay, receivables is increasing when you're selling it on credit. Okay, when asset is increasing, it goes to the debit side, like you can see. So that's why debit receivables. Credit sales. What is sales? Sales is nothing but revenue. It is income. Okay, income is increasing here, credit side. Okay, got it? This is how easy journal entries are. You just need to analyze two things. For example, whenever we're talking about purchases on credit or on cash, let's use the easy one on cash. Okay, we have to deal with two things: purchases and cash that we are paying. Okay, whenever we are doing purchases and cash, purchases is an expense for us. Okay, and cash is asset. Whenever we are making a purchase, is cash going out or coming in? Going out, correct? Asset is reducing that way. Which side was asset supposed to come? Debit side. Okay, but since asset is reducing, it doesn't go to the debit side, it goes to the opposite side, which is the credit side. That's why cash we will credit. Okay, if at the same time cash was increased, receivables, credit sales, here it is debit returns and credit receivables. Okay, here receivables are reducing because we have to pay back. They have returned our product, now we need to pay them back. Okay, whatever they've given us. So that's why we'll not be getting receivables anymore. Receivables is an asset, asset is reducing, that's why credit side. Usually receivables comes on the debit side. Okay, sales returns. Sales is an income for us, sales returns is an, what could it be? Expense for us, right? So that's why we are taking on the debit side. That's it. Very simple, guys. So this debit credit, we'll keep doing it in every chapter. Okay, so now what is a new thing that we'll be dealing with is sales tax. What is sales tax? Sales tax is the tax that government demands for any sales, basically. Okay, now ultimately whoever is the final consumer should be the one who pays the tax, but business is never the final consumer, right? Because let's say a company, a manufacturer sells it to the company will not be sitting, we're talking about ice cream, let's say manufacturer sells the ice cream to the company. Okay, company will not sit and eat the ice cream, instead they will buy it to sell it to the customers, correct? So is the company the final consumer? He is not the final consumer of the product. Okay, that's why he's not the one who has to pay the sales tax. Got it? So understand this, there are two types of sales tax. One is input tax, one is output tax. Input, whenever you're understanding this, remember purchases, goods coming in. Okay, goods coming in, purchases, input tax. Goods going out, selling, output tax. That's how you remember input tax and output tax. Got it? So whenever it is input tax, that means whenever you're purchasing goods, as a company we are talking about, whenever you're purchasing goods, you can recover that particular thing from whoever you're selling to. Okay, output tax is just the opposite. Sales tax charged and collected by sales by business. This is payable. Okay, so sometimes what happens is, if input tax is more than output tax, you can get a refund for it. Okay, and when output tax is more than the input tax, you'll have to pay the extra tax to the government. So in the end, your transaction should be balanced. You cannot be paying more or getting anything extra. In the end, the government should be getting all the sales tax. Okay, let's read through this once. It is a tax levied on final consumer of the product or service. It varies globally. Businesses registered for sales tax act as collection agents. We are just the agents. We are not the final consumers. Okay, right. So this is what you need to just look at this table. Whenever you're purchasing, like I said, goods coming in, purchases, input tax. Sales, goods going out, sales, output tax. That's how you need to understand this. This is the journal entry. Debit, purchases, debit sales tax, credit payables, debit receivables, credit sales, and credit sales tax. Okay. Like I said, whenever output tax is more than input tax, you pay to the tax authorities. Okay. Whenever output tax is less than the input tax, you can get a refund from tax authorities. For example, you are buying from manufacturer, company, customer. Okay. You are buying from them, they are buying from you, customers are buying from you. Okay. Now, for the manufacturer, you have to get the you have to give some money to the manufacturer. That is the tax, right? You're purchasing thing, input tax, remember? Okay. So now let's say the tax here was 20. Your main goal here has to be to recover that 20. If you're not recovering that 20, let's say you're only recovering 10, then the remaining 10 government will refund it to you. Okay. But instead of 10, instead of like not getting 20, if you're getting 50, then you will have to pay, how much is it, 20, 30 to the government you will have to pay. This is what it means. Got it? So whenever you have to pay it, you'll have to do debit sales tax because this becomes an expense for us. Credit cash, because cash is an asset debit side, but then asset is reducing here, that's why credit side. Whenever you have to get a refund, that becomes an asset for you. That means debit cash, asset coming inside. So cash is increasing, asset increasing, that's why debit side. Okay. Coming to sales tax, credit, because expenses going down. Got it? Now, sales tax could be a tested topic because from these few chapters, from the 4th chapter, that's the only important thing I would say. I mean, other than the discounts and sales tax. These are the two most important things that we'll be dealing with in chapter number 4. Got it? Right. Next part that we'll be dealing with is discounts. Okay. Discounts, there are two types. One is a trade discount and one is a settlement discount. Trade discount is very simple. There is no, not a lot of adjustment. There's nothing to do. But settlement discount, you'll just have to remember two theories. And with this, we'll be done with this chapter as well. Okay. Now, what is trade discount? Trade discount is, you're randomly, like, this is you. Okay. This is your customer, company. You sell something to the customer. Customer has to pay you money, right? While selling itself, you will tell. While selling itself, you will tell what is happening. Okay. So when you're selling the goods, what will you tell? You will tell that I am going to give you discount. I'm going to give you discount. Okay. So then what will happen? The customer is going to be like, oh my God. Travel minds, yes, you can ask me whatever doubt you have. We will answer it before the class ends. Okay. Fine. See guys, so you as a company are giving discounts to a customer. Customer is going to be overjoyed. He's going to think, oh my God, what an amazing business. Without doing anything itself, they're giving me discounts. I have to go and give them, I have to give them more business. I have to buy from them from next time. I'm not going anywhere else. You're going to just make them very happy and you're going to retain customers that way. Okay. That is trade discounts. Without asking for something extra, you're just giving them discounts. Okay, let's read. A reduction in selling price offered by suppliers to boost sales volume and customer loyalty. Trade discounts are applied at the point of sale and reduce the unit price. So there is no extra adjustment for this. If they tell, when I buy this, I will give you 10% discount. That's it. So let's say it's for 1,000 rupees. 10% discount is how much? 100, right? So now immediately 1,000 is not going to be your amount. It's going to be debit 900, credit 900. That's it. Directly you can add in the, take away the 100 rupees discount or $100 discount, and then you can just include the final figure here. Okay. Finally, coming to settlement discount. Settlement discount is, it encourages customers to pay. What is the meaning of this? Let's see. Now, you again are the company and there is a customer. Okay. You are the company and this is the customer. Okay, now while selling, you're not giving them any discount. So like, yeah, just take it for $1,000, take it. Okay, now the customer will also be like, okay, fine, I'll take it on credit, I'll pay it back later within 30 days or something. Now you will tell, okay, 30 days, that's a long time, what should I do about it? So then you'll tell, okay, if you pay me back within 10 days, I'll give you a 10% discount. Okay, something like that. And then the customer will be so happy with this lucrative offer. He's like, okay, fine. So if I pay within 10 days, I will get discount. That's an amazing offer. I think I should take it up. So then that is called settlement discount. Okay, he will offer a percentage of discount if payment is made within a set time. That is settlement discount. Got it? Now, in this scenario, you can either be the supplier or you can be the customer. Okay. Here we were talking about you as a company, but at the same time, let's say this is you, this is the company, but this is a supplier. Our suppliers are telling us, if you pay us within this time, we will give you discount. Okay, now it's your job to decide whether or not you take the discount here. So if you are taking the discount, if discount is being received, then it reduces their payable. For us, payables is reducing. Then we will debit payable, because payable, again, let's see, debit, credit, debit, AE, credit, LIC. Okay. Now, debit payables. Payables is nothing but a liability. When liability is increasing, it becomes credit. But here, payables, liability is decreasing. That's why it goes to the debit side. Discount received is going to be something like a revenue for us. Okay, discount received is going to be a revenue for us. So then this will be credit side for us. Okay. Cash at bank, again, reduced cash payments. Cash is nothing but an asset. Asset is increasing. Why? Because payments are being reduced. That's why credit side. Got it? Okay. I mean, cash is still going out of the business. That's why it is debit. That's why it is not debit. Okay. Debit is when money is coming into your business, but here it is not coming into your business. It is just, it's going out, but a little less than what initially should have gone out. Got it? Now, if you are the company, if you're the supplier, you are allowing it, then this is how it works. These journals you need to remember. I mean, you do not have to by heart it. Just understand the logic and then it'll be easier for you. Okay, got it, guys? Next. Now, this is where the standards start. Okay, inventory is nothing but IAS 2, which is a standard. Okay, now inventory is a very, very simple chapter. We do not have much to do in inventory. Okay, right. So now let's see. Inventory is a measure at the lower of, now we'll be learning how to measure inventory. Inventory is measured at the lower of cost and NRV. Cost is how much you purchase the inventory for. NRV is the net realizable value. That means how much you can sell it for. Okay. Also known as fair value less cost to sell. Now, for example, let's take, you purchased this water bottle for $10. Okay. Obviously, nobody wants to like repurchase something like that, but still, we're just going to assume this is a rare product, $10. Everybody wants to purchase this, etc. Okay. Now, with this is the cost. Net realizable value, however, is how much can you sell it for now. Okay. Now, somebody will be like, okay, fine, I will purchase it. I will purchase it for $9, but then you need to fix this cap for me. And to fix the cap, let's say it takes $2. So net overall together, if we look at it, we are getting $7. Correct? Now, which is lower in this, you purchase for 10, but now you can sell it after incurring cost of 7. Okay. So then 7 is going to be the value in our books. That is how inventory is going to be measured. Got it? Okay. Next is the format. Now, this format is going to be very important for you because we'll have to learn. Okay, we'll have to learn the SOPL, SOFP, SOCIE, etc. All these financial statements we'll need to learn. And for that, we'll need to go step by step. Correct? So we always start with revenue. So it's like this: revenue minus cost of sales. It gives us gross profit. This is the main formula, right? But now this cost of sales has a formula within itself. So that is opening inventory plus purchases minus closing inventory will give us cost of sales. Okay, so whenever they are asking you in question, if they ask you what is gross profit, first you need to calculate the revenue, then you need to calculate the cost of sales, which includes these three steps, and that's when you can find the gross profit. This is a kind of question that could be tested as well. Got it? Okay, this is fine. Right. Next is methods of calculating the cost of inventory. How can you calculate cost of inventory? There's unit cost, there's FIFO, and there's AVCO. Okay, average cost. FIFO is first in, first out. Now, earlier there was something called last in, first out also, but then we do not. ACCA doesn't encourage that technique anymore. So in any of the papers, you will not find LIFO. Okay, it used to be there earlier. Right. So first is unit cost. What is unit cost? Unit cost is the actual cost of purchasing. Now, if you look at these high value goods, for example, which are not manufactured in bulk, okay, let's say these Jimmy Choo shoes and Gucci bags, etc. So all these things are not manufactured in bulk and then thrown away like this in warehouses. You keep everything is very, very expensive. So everything is this high profile item, correct? So for that, we'll have each will have one cost. Okay, it's a distinguishable high value item. But when we look at FIFO is like this. Whatever we are, it's all in bulk after this. So whatever we are purchasing first, okay, we're gonna sell it first. For example, milk store is there. There are too many milks. So this is from 3rd May, 4th May, 4th May, 5th May, right? So which one did you purchase first? The 3rd May one, correct? So our job is to sell this first. That is FIFO, first in, first out. Okay. Finally, we have AVCO, which is average cost. So what we do here is we find the average after every sales. So here there are two ways in which you can find periodic weighted average and continuous weighted average. What is periodic weighted average? Weighted average that calculates unit cost after every purchase or sales during a period. During the period, at the end of the period. Continuous is when after every purchase and sales, you calculate the weighted average cost. Okay, now let's say we have first day we bought 10 goods at $10, then second day we bought 5 goods at $5, third day we bought 2 goods at $5 again. So what's the total cost now? 100, 25, 10. So total cost is 135, correct? Now this is how it is. And then what we do is, if we are looking at periodic weighted average, how many goods are there total? 15, 16, 17. So we do 135 by 17. I do not know how much it is. I'm not that great at math, but that is periodic weighted average. If you're looking at continuous weighted average, it's gonna go like this. 10 at 10. Here, what is the average cost? 10 divided by 10 at 10 is 100. So 100 divided by 10, 10 per unit. Okay. Second day again we get 5 at 5. So here 25 divided by 5, that is 5 per unit. Now we'll take the average of these two, which is 15. Correct? So 15 divided by 2, 7.5. So now correct, no? So this is gonna be the average. Here I don't know how much is the average. Let's calculate so we can compare it. That is 135 divided by 17. That is 7. This is 7.5. Okay, this is 7.94. Okay, right. So you can compare how this is. You can compare how this works. Okay, so here it's a different figure. Here it's a different figure. Although we are looking at the same amounts. Now again, if we add 2 at 5, then again it changes the amount. That is continuous weighted average. You will be asked to do questions like this as well. So you need to be sure about it. So this periodic weighted average and inventory systems, there's again periodic inventory system and perpetual inventory system. Now this is very simple. Okay, periodic is you do the calculations manually. Okay, now this is very well appreciated if small companies use it because they do not have money and need to use this big technology. But perpetual inventory system uses a POS system. What is POS system? Real time. Okay, so after every purchase or after every sale, we'll automatically look at how the inventory count changes. Okay, we do not have to do anything manually. So for these big companies, large business, etc., where inventory is too much, that's when you can use perpetual inventory system. Got it? Right, with this we are done with the chapter number 5. Now chapter number 6 and 7 we'll do it together. Okay, so chapter number 6 and 7 both deal with non-current assets. Non-current assets come under the standard called IAS 16, property, plant and equipment. Okay, here in chapter number 6 we'll be dealing with acquisition and depreciation. Next chapter will be dealing with disposal and revaluation. Got it? Non-current assets itself. Okay, here what is non-current assets? Current assets are something that can be converted to cash within 12 months. Okay, non-current assets are more than 12 months, that is more than a year basically, right? So they are long-term assets, they are held in business operations, they are not held for resale. All this is a definition. Now, okay, we will see always in your SOFP, which is the balance sheet, we will not include non-current assets at cost. We will include it at carrying amount. How do you calculate carrying amount? It is the cost minus accumulated depreciation. Now, what is accumulated depreciation? Accumulated depreciation is how much the value of assets reduces each year that we use. Okay, so accumulated depreciation is a total depreciation from ever since we started using till now. Every year we'll have depreciation, we'll add it to the accumulated depreciation and move forward to the next year. Got it? Key characteristics: held for long-term use, not intended for immediate sale, similar to whatever was there in the definition. Okay. Now, within non-current assets, there are two expenditures we'll deal with. One is the revenue expenditure, one is capital expenditure. Okay, revenue expenditure is something that deals with day-to-day cost. It is an expense. Okay, but capital expenditure is something that deals with increasing the business value. Okay, business or asset value. Now, this can be done through like increasing the life of the asset, or it can be done through making the asset very having the highest quality, etc. That's capital expenditure. Got it? Right. So understand, capital expenditure is always treated as an asset. You capitalize it. Revenue expenditure is you take it in the expense, which is nothing but the which is nothing but the SOPL. This goes to SOFP. Okay, for example, purchase of equipment or any major upgrade, whatever happens, that is capital expenditure. Something like small, like repair, etc., that goes to revenue expenditure. Now, there's one register that we deal with that talks about all the non-current assets that we have, so that we can have a proper, like, count of whatever we have. That's called non-current assets register. So in this, we'll have the description of what the asset is. We'll see when we purchase the asset, we'll see how many years are left for that particular asset, etc. Multiple, all the things that you need to know about the asset, you will get to know through this particular non-current asset register. Okay, this is important. Whenever you're looking at cost, you need to know which one is expense, which one is capitalized. You will get it for MCQs. Learn this. Okay, what do we capitalize? We include purchase price, delivery, this, that. This is for the cost of the asset. These four things we will not include in the cost of asset. Okay, administration cost, overhead cost, all this doesn't come under the cost of asset. It comes under admin expenses. It goes under selling and distribution, etc. Okay. Now, again, we'll learn about depreciation. Very simple topic. Depreciation is a systematic allocation of cost of an asset over its useful life. Okay. When does depreciation begin? Not when we are using the asset, but when it's not when we are making revenue out of the asset, but when we start using it itself. Okay, depreciation methods. We'll be learning two types of depreciation methods. You could be asked to do sums with regards to how much is the depreciation, etc. Okay, solve a lot of exam kit questions. This is the formula. Okay, for example, let's see. So we purchased a machine at 10,000 and its residual value is 2,000. So residual value is in the end the scrap value. So how much is it going to be sold for in the end? That's the residual value. Okay. Right. So now, number of years that we can use the asset is going to be 8 years. I'm just going to simplify the maths for me to the next level because I do not like doing it. So then, according to straight line method, our depreciation should have been cost, which is 10,000 minus residual value 2,000 divided by 8 years, which is 8,000 divided by 8. 1,000 is going to be the depreciation per annum. The value of the asset will reduce by 1,000. So year 1, the value will be 10,000 in the beginning of year 1. Okay, at the end of year 1 it will be 10,000 minus 1,000, which is 9,000. Again, the second year it will be like this. Okay, it will keep going like that. Coming to reducing balance method, the carrying amount is cost minus accumulated depreciation into the percentage of depreciation. Okay, that's a formula for reducing balance method. Okay, so now, how does depreciation affect our financial statements? In SOPL, depreciation is an expense. It reduces profit. Okay. In SOFP, depreciation is being reduced from the cost of the asset to give us the carrying amount. Carrying amount is cost minus depreciation. Remember? So that carrying amount will be going here. Coming to cash flows, depreciation is a non-cash expense. You're just assuming it's an accounting entry. Okay, no cash is going in, or no cash is coming in, or no cash is going out because of depreciation. So that's why you will add it back in operating activities. You will not understand this until we go to the cash flows chapter. Okay, for this one, how do you know whether there's a profit or loss on disposal? Proceeds minus carrying amount. What is carrying amount? Again and again I'm telling you, it is cost minus accumulated depreciation. What depreciation you've been accumulating from the day 1. Okay, now let's say here at the end of 2 years, now the value becomes 8,000 for the asset. But my friend comes and he's like, I want to buy this asset, I will buy it for 9,000. So now this is the proceeds value. How am I making profit or loss? Now the value of asset is 8,000, but I'm getting 9,000 if I sell it. I'm still getting a 1,000 profit, correct? That's the formula. Now to calculate the disposal, this is the formula that we'll be using. Debit, original cost will be here, depreciation. These tables you need to remember. Okay, I'll give you a moment to take a photo of this. Okay, now we'll go to part exchange agreement. What is part exchange agreement? Let's see, this happens a lot in Indian families, correct? So what we do is, we will go to buy jewelry, okay? And whenever we are going out to buy jewelry, what we do is, whatever the other jewelry that we didn't like, we will sell that and we'll buy new one, correct? So now let's say we want to buy a machine which costs 50,000. Okay, but we also have an old machine which we need to sell. Just for that, the replacement we're buying a new machine. So for this old machine, the value right now is 10,000. Okay, we want to buy the new machine, we want to sell the old machine, so we need to do this agreement, right? So now you go to the store and you're like, see, I have an old machine, I want to sell this, and at the same time I want to buy a new machine. So he'll be like, okay, fine, it's for 50,000, 10,000 is the old machine, now you'll have to pay me just 40,000. This is part exchange agreement. What do you do? It's when business trades old asset as a part payment for new asset. See, this 10,000 is going to be a part payment for us for the new asset, correct? This is how it is. Okay, and remaining cost is paid in cash. Right, so how do we do? First, we'll remove the old asset. We will take it out from our books like the normal disposal method, and then we'll record the part exchange allowance P value, that is PEA 10,000. We'll record it. We'll treat it as sale proceeds of old asset. Okay, and then the new cash payment, that 40,000 that we paid, that we'll record as buying a new asset. Okay, and then finally we calculate the gain or loss on disposal. That's it about depreciation. Now we'll go to this new topic called revaluation. Okay, with this we'll be done with that chapter as well. Revaluation is showing the fair value of an asset in the statements. Okay, how do you do it? It's a process of adjusting the carrying amount of non-current asset to reflect fair market value. Some assets like land, building tend to increase in value over time due to factors like rising. Okay. Since companies want the financial statement to reflect the true value, they revalue them instead of continuing to report at their original cost. So what are they telling here, guys? See here. There's a machine. Or let me just take, there's a land. 100. Okay, so now there's an increase of 100, right? Yes, we have not sold it yet, so the money is not coming into our business yet. Okay, it is called unrealized profit. Okay, that's why whenever we realize it, we do not take it as an income in SOPL, but this 100 is gonna be an income if we sell it. That's correct, right? But we haven't sold it yet, so that's why we cannot take it under SOPL as an income. Instead, there is a thing called OCI, other comprehensive income. In that place, we will store revaluation surplus until we sell the asset and we can realize the surplus. After that, we can take it to the SOPL. Got it? This is revaluation. See here. So now what we do is any increase goes to revaluation surplus, not in SOPL, not in profit and loss account, but in OCI, other comprehensive income. But at the same time, if there's any decrease, for example, here, land was 200, but later it became 100. Okay, why did it reduce in value like this? Because of, let's say, they built a cemetery in that area. So now the value of land has automatically gone down, not increased, decreased by 100. Now this is still unrealized, but it is an unrealized loss. In that scenario, it will not go to OCI as revaluation surplus. It will go to statement of profit and loss as an expense. They are so biased against income and expense. So whenever there is expense, even if it is realized or unrealized, it goes to profit and loss account. But if there is a profit, first they'll see, is it realized? If it is realized, it will go to SOPL. If it is not realized, it will be taken in OCI, other comprehensive income. Okay, because if we take it in SOPL, the shareholders might ask, okay, you've shown this $100 increase, where is the money? They will ask that, correct? So we do not want such questions to be raised at our company. That's why we are doing like that. And after that, after you revalue it, now let's say we'll go back to that, it was 100 and then it became 200, right? On this new value, we will start our depreciation. Got it, guys? That's it. Okay, next is chapter 8, intangible asset. Intangible asset comes under a standard called IAS 38. Okay, they are identifiable, they are non-monetary asset, they do not have physical substance. Okay, easy, right? So we have goodwill, patents, software, etc. All these are intangible assets for us. Now, how can you classify something as an intangible asset? One, it should be controlled by the entity, similar to non-current assets. Okay, if there is any future economic benefit that's coming from the entity, that should come to the, if there is any future economic benefit that's coming from this particular asset, it should come to the entity. Okay, it should be identifiable and distinguishable. This is one of the main concepts, because many intangible assets cannot be separately distinguished and identified. Okay, so now goodwill is an intangible asset, correct? Is that what you all agree with? Okay, but goodwill, even though it is an intangible asset, first you need to know whether it is internally generated goodwill or business. Okay, there's another type of normal goodwill that we can buy through businesses using a business combination. So external goodwill, let's say. Let me give you an example of internally generated goodwill. For example, ArivuPro, you know, we have chairs and tables, all these are assets, correct? But at the same time, if we just take money for just the tables and chairs and the pen and the bottle and the TV, etc., it is not going to cover up. That's not the value of the company as a whole, correct? Because people have some, like, you know, goodwill, right? People have some good opinion on the company. That is also a added advantage to us. So that's why all that will come under internally generated goodwill. We didn't purchase it. It just happened because of the business. Okay. Now, can a company come to us and then they'll be like, see, just sell us your goodwill? Can that happen? Can we ever sell our goodwill to anyone else? If a competitor comes, let's say I start a business of my own, Nena ACCA Foundation or something like that, I cannot run and come to ArivuPro and be like, please give me your goodwill. I will not want your company or anything, just your goodwill. I will pay you for it. We cannot do that. Okay. The goodwill of ArivuPro is not separately distinguishable from ArivuPro as a company. Okay. Such internally generated goodwill cannot be intangible asset. It is not distinguishable, not identifiable separately. That's why it cannot be an intangible asset. Got it? But at the same time, if I'm coming, if again, then Academy, yes, go ACCA, that if I tell, and if I come and tell ArivuPro, see, I want to buy your company. Just give me the company, and along with that, obviously, goodwill also I'll get, right? When I'm buying the company with the goodwill, that is external goodwill. This happens during business combinations. Especially, what is the meaning of that? When I'm purchasing a business. Okay. In such a scenario, goodwill is separate. Okay, we can purchase such goodwill, but internally generated, okay. Now, under intangible assets, there's this one main thing that we need to deal with, which is research and development cost. Now, obviously, in startups and all, there would be a lot of money spent on research in the initial days, correct? The company will probably not be profit making, but then it'll spend a lot on research and development. Now, research is always an expense. Development cost can be capitalized, that means can be taken as an intangible asset, but only if these criteria are met. What is this criteria called? Pirate criteria. Okay, PIRATE. P is probable future benefit, I is intention to complete, R is resource should be available to complete it, A is ability to use that particular asset or sell it at least, T is technical feasibility, that means we should have sufficient technology to be using this particular asset, and E is expenditure measurable. So whatever expenses that we need to be able to measure it. Got it? So this is the pirate criteria. If the criteria is followed, along with this normal rules are followed, that can be classified as an intangible asset, that is development. Research can never ever be classified as an intangible asset. We always expense it. Got it, guys? Now, just like how in intangible asset we have just how like in non-current assets we have depreciation, in intangible assets we have something called amortization, which is just like depreciation but for intangible assets. Now, whenever we look at amortization, we need to see if the intangible asset has a finite life or an infinite life. Now, what is the meaning of having a finite life or an infinite life? Now, for example, let's say Puma is being endorsed, the ambassador is Virat, right? Now, what is the meaning of this? The brand value that Virat has will also be portrayed in Puma, right? So now, whenever we are looking at it in that scenario, we do not know how long this intangible asset is going to work for us. His value, yes, it is there. We have intangible asset, correct? But this particular value, we do not know when it will stop. Okay, maybe something can happen and people can stop liking him. That could happen. But for the foreseeable future, we do not know where it ends. Correct? Then we assume that to be intangible life of amortization. Okay, intangible life of infinite life of assets, intangible asset. But finite life is something like normal patent. If we are getting a patent for our product, we know, we'll tell this patent is going to be for 5 years. Then that's a finite life. That's it. Okay, that's the difference. Right. So now whenever there is finite life, you can easily amortize it. For example, let's say for patent, we spent $100 and that's going to last for 5 years. So that's going to be 20 per annum is going to be our expense according to amortization. But for infinite life, we cannot do anything because we do not know how many years it's going to function, right? So that's why what we do, we do not amortize infinite life intangible assets. Instead, what we do, we test for impairment. Impairment we need to do. How are we going to test for impairment? By doing an annual impairment review. Got it, guys? Okay. Okay, next is measurement of intangible assets. There are first initial recognition should be done at cost itself. But subsequently, what you can do is you can measure it at cost, like how you've been measuring, or revaluation model. Now, the problem with revaluation is many people do not do that because revaluation for intangible assets is going to be very hard. We might not have an active market for it to find out how much is the actual value right now in the market. Correct. So if that's the case, we do not know how much to like put as a value under revaluation model. So this becomes a little more harder to estimate. Okay, that's why people usually stick with cost model when it comes to intangible assets in initial and subsequent measurement. Got it? With this, we are done with chapter number 8. Next, chapter number 9, we have accruals and prepayments. This is a very short chapter. This is all you need to know from this chapter. Okay, that's it. Then we can go to the 10th chapter. Now, for this, you need to understand what is accrual and what is prepayment. What is prepayment? When a company is already paying for an expense before using the services. For example, let's say rent. Okay, for the next month's, for this month's rent in advance, we're already paying. Okay, so that is it's May is gonna get over. So for June, let's say my rent expense is 20,000. Now for the whole month of June, I've already paid it in the 1st of June. That means that's in advance, right? So that is prepaid. Correct. Now we have two types: prepaid expenses and prepaid income. Okay, now here I'm talking about rent, which I'm gonna pay, so that is prepaid expense. So I've already paid for the rent. The only thing I need to do is take the advantage. That's it. I've paid for it. There's nothing else left. So that's why this becomes a current asset for us. We've already paid for it, right? The only thing left for us is using its services. Just the opposite of that is prepaid income. So like just now when I was talking about rent that I need to pay, let's say people should pay me rent, the same thing. Rent of 20,000, someone else is paying me. So in advance, that is. So now I've already received the payment. This becomes a liability for us. Why does it become a liability for us? It relates to the future period. Now I've already been paid. The only thing I need to do is sit and keep working. Now I cannot look forward to the future payment that's gonna come. Got it? That's why. Current liability and current asset. Where is it? Recorded as current asset. Yes. So this is all you need to know about prepaid. That's fine, right? Now just the opposite of that on the other side is what accrual is. Accrued expense, you will not pay it in advance, but you will pay it after using the service. Okay, what is the meaning of this? Accrued expense represents expense incurred during financial period but not yet been paid. For example, let's take the same example, May. Okay, this time rent for May. Now for May, I have not paid my rent yet. Let's say on the 31st of May, the last day, I will sit and pay that day. Okay, so right now I'm just using the facilities. Okay, I have not paid yet. Now in my mind, I'll always be like, oh shit, this month end, I'm gonna have to spend 20,000 on rent, right? That's always gonna run in my head. That is accrued expenditure. Okay, I have not paid yet, but I am using the services. Okay, now let's say someone else needs to pay me rent. Okay, month end, May 31st, they will pay for the whole month of May. Now what is it? We've already given them the service. May is gonna come to an end, right? But I have not received my payment yet. So the only thing is, okay, I have given my service. Now I should just peacefully sit and wait for the money to come into my account. That becomes an accrued income. This is accrued expense. Got it? Now when we haven't paid yet, they are gonna be paid later. Okay, my payment is gonna be stuck in my head. I'm like, oh, I have to pay this, etc. Okay, but here someone else should pay me. I've already given them the service. Now the only thing is sit back, relax, and then take the money from them. This becomes a current asset. Got it? This is all we need to learn in this chapter. Understand the difference between accrued expenditure, prepaid expenditure, accrued income, and prepaid income. Got it? Next, guys. Now we'll go to chapter number 10, which is receivables and bad debts. Now again, these next few chapters are going to be very simple. This is receivables, and then we have payables, and then we have capital structure. We have reconciliation. Very, very simple. We can finish it off quickly. Okay. Okay, right, it's almost been 1.5 hours since we started and we exactly finished half of the portions. That's good. That's good progress, right? Because we thought in 3 hours we'll finish it. We will, don't worry. Okay, now guys, whenever we are talking about receivables and payables, I would strongly urge you to remember this table. Okay, this one and the payables table. Okay, I'll tell you the type of questions they ask. Okay, So now let's say we have the information for this table. Like most of the information will not be necessary, but we have information from this table. Let's say these small things, like they'll ask you what is the credit purchase for the year. Now for that we need to find out the whole thing, find the balancing figure here, and then we need to do the balancing figure and find out the credit purchase. That type of question. So for that you need to know the table. There is no other alternative choice for you. Okay, or you can use your common sense and go ahead, but then that's going to take a little more time. Okay, we do not want to waste time in ACCA exams, right? Now similarly for trade receivables, they can ask you how much was the credit sales for this year, find it out, and they'll give you the other information like this is how they're going to ask you questions. So that's why I would strongly urge you, request you to understand the table. Okay, and then you can go ahead. So this is just debit and credit side. You will need to know the normal debit AE and credit LIC rule to understand this. Okay, this is the normal credit sales journal, and credit sales, that means in credit you have received, receivables come in, later receivables should be paid, and then cash increases, receivables reduces. This is the journal entry. Okay, now why do we need to give credit to customers? So that we can access new markets. Why? If people get credit, they will be happier to use the products that we are selling. Okay, and boost sales, encourage customer loyalty. Yes, but at the same time the costs are delayed cash inflow. The thing that we could get paid for right now, we are not getting paid for because we want to be in the good terms of customers. So we are doing a little bit according to what they want. Next is risk of bad debts. Yes, immediate cash payment will not have any bad debts, but whenever it comes to credit, maybe something could go wrong and the customer will not pay you back. Okay, not this cannot be controlled. In a business, it's always going to be there. Okay, and then cost of follow-up and credit control, that is a big headache. Okay, that's why we go and outsource this to someone else called factor. Right, age receivables analysis. Now this and this could be the only tricky topics within this. Okay, now sometimes we give the credit period of 30 days, let's say, but within 30 days also we have not received the amount back. Okay, 1 second. So what we need to do is we need to see what are overdue amounts here. Okay, for that we'll need to do something called aged receivable analysis. We will see how many old receivables are pending. Okay, how many are there, so that we can figure out how to collect them fast, quickly. Okay, and if we have any doubts that money couldn't come back, then we will create something called allowance for doubtful debts. We have a doubt, we could still receive it, but then we are creating this reserve. Okay, we are telling maybe we will not get it, so that we can be mentally prepared for the amount that we're losing. Okay, that's one thing. Irrecoverable debts is when we have confirmed that the customer cannot pay us back. In such a scenario, irrecoverable debts will be taken into consideration. So receivables will be 100, let's say. Irrecoverable debts out of that is 20. Our new receivables balance should be 80. We have to write down receivables to show the irrecoverable debts. Recovery of previously written off debts. Now we had written off this $20, right? But because of some happy news, maybe you did something great in your life, so you had to be rewarded, and that's why you are getting it back. Okay, so when something like this happens, we'll need to be reversing it. Okay, so here you can see what we did. It was irrecoverable debt expense, debit and credit receivables. We will credit back the irrecoverable debt expense because it's not an expense to us anymore. We are getting the money. Okay, and cash at bank, right? That's it in receivables. Payables also will continue at the same time because we can understand it better. Classification. Okay, payables is a liability, guys. Liability is it's a liability. Liability can be of two types: non-current liability and current liability. Payables is a current liability. Okay, that's one thing you need to know. That's it. Here there can be nothing like bad debts, receivables, etc. You have to pay here. You will not be analyzing whether or not you will only pay. Okay, right. So now under this we have something called provisions. What are provisions? Provisions are something of a liability of uncertain timing or amount. What is the meaning of that? We have a liability, we know it's coming, okay, but we do not know when or how much. Okay, that's going to be very sad, because you know something bad's going to happen, but you do not know how much you're going to spend or what that thing is. Okay, so now provision can be under both current and non-current, and every reporting date, every year end, you will sit and check whether there is some sort of provision there. Okay, how do you recognize a provision? This word is very important. Provision needs to be present, needs to be probable, and needs to be reliably available. Sometimes they will tell we have a provision, but it is possible, not probable, possible, they are telling. It is wrong. It cannot be a provision then. Got it? Only if it is probable and you can reliably measure how much is the cost that is gonna be incurred, that's gonna be provision. Now, present obligation, I told. Obligation can be of two types. One is legal and one is constructive obligation. Legal obligation, that is something that arises out of the contract. Okay. Constructive obligation, however, is something that can be created due to past expectations. Okay. So, can we classify past practices creating a valid expectation? So, from the past 10 years that your business is running, you've always given a refund for candy. So one fine day, if you run and come and be like, no refunds for candy from now on, that is not gonna happen. Okay, because people have been expecting it. From the past 10 years, you've been doing it. It doesn't make sense to run and come and make a new rule there. Got it? Right. So now we have something called contingent liabilities. Contingent liabilities are like provisions, but in contingent liability, it is not probable. It is possible. Got it? That's the main difference. But also, probable means what? More than 50% chance of it happening. Possible is when there is more than 10% but less than 50% chance of that happening. Okay. Now, if it is a very important contingent liability that's going to be incurred, you will disclose it in the notes. Nowhere else. Not in your balance sheet, not in profit and loss account, not in cash flow account, nothing. Contingent assets, however, is also similar to contingent liability, 10 to 50%. Okay, it's a possible asset again, like contingent liability. But here, if and only if the outcome is probable, then you disclose it in notes. If it is possible, like this, you will not disclose it. So guys, understand, contingent asset can be possible or probable both. And liability, let's say it can be contingent liability or provision. So provision is probable. Contingent liability is possible. Here possible and probable, same under contingent liability. But now guys, possible will go to notes. Probable will go to the financial statements. Okay. Here possible will go to nowhere. We do not care about possible assets. We only care about certain assets. Okay. Probable will, however, go to notes. I told you, right, how they always discriminate against assets and liabilities. So if you can understand this table, it's all very simple. If it is probable and contingent liability, you recognize a provision. But if it is not reliably estimatable, or if it is possible and not probable, then what you do? Take it under contingent liability. Similarly, if it is possible, contingent liability, disclose it in notes. But possible and remote, here you ignore all the three. Only if it is probable, you disclose it under notes. Got it? This table basically summarizes the provisions, contingent liabilities, and contingent assets. And on top, there was just payables, nothing else. This chapter is also very simple. It's done. Okay. Now coming to chapter 12. Chapter 12 deals with capital structure, which is how are we financing the company. Okay, here the way a business finances its operations must be a mix of debt and equity. Debt is something that you're borrowing from people, you have to repay it along with interest. Okay, equity is some sort of ownership fund. Now you invest in the company, you become the equity shareholder, you become the owner of the company. Under this, we have ordinary shares, loan notes, preference shares, etc. Now, under preference shares, guys, ordinary shares is equity, loan notes is debt, but preference shares can be both debt or equity. How? If it is redeemable. If you have to repay it, then it becomes debt. If it is irredeemable, you don't have to repay the principal, but normal interest you'll repay, you'll keep paying, that becomes equity. Now, how do you account for it? Equity, there can be three types. Okay, and along with that, there's also retained earnings. We'll look at that. We have ordinary share capital, very important journal entry, debit, cash. Cash is an asset. Asset increases every time you issue shares. Okay, share capital and share premium. Okay, what is the meaning of this? Let's say we issue shares of nominal value or face value 10. Okay, but we issue it for 100. Got it? Now, how many shares do we issue? Never mind. Okay, so we'll do debit cash. How much are we getting total? Credit share capital, credit share premium. Our share capital is the nominal value, which is 10. Cash is how much are we finally issuing it for? 100. But what is this extra 90? If the value was only starting at 10, the remaining 90 is the premium. Okay, that's the extra money that people want to give it to you just so that they can buy your shares. Got it? This is how you do the journal entries. Could be tested. Journal entries are very, very widely tested in FA. Rights issue is shares offered to existing shareholders at discounted price. So rights issue is basically like this. We'll issue normal share capital. The journal is also similar to that, but then we issue at a discounted price. That's it. That's the difference. So for example, here it is $100, right? Probably for the existing shareholders, we'll make it 50 or something like that. Okay, the journal entries will remain the same. But if we are talking about the bonus issue, that means here no extra money is coming into the business. Instead, share reserves will have some monies, reserve fund basically. Okay, that from there we'll convert it to share capital to make it look like we have issued extra shares. Okay, so whoever are the existing shareholders, for them we'll give free shares. That is bonus issue. Got it? So you don't get any cash inflow from this. And finally, retained earnings. This is the profits that the company make. We do not distribute it as dividends. Instead, we keep it in the business. So that becomes retained earnings. So this retained earnings, you can use it to fund any projects. We can use it to give dividends. We can do anything with that particular thing. Okay. Now under debt, we'll be dealing with two things. One is long-term loan notes and one is preference shares. Which preference? So preference, redeemable and irredeemable. Redeemable, like I said, irredeemable is equity. This is debt. For debt, we deal with finance cost and bank. Okay, we keep paying interest regularly. For this one, we deal with equity, right? So nothing like interest for us, but then we'll always get fixed payment. So long-term notes, when loan funds are raised, we do debit cash because cash is coming into the business. Cash is an asset. If asset increases, it goes to the debit side. Non-current liabilities, liability is increasing. Whenever liability increases, it goes to the credit side. That's how we do the journal entries. Similarly, that's when funds are coming into the business, and then when your interest is being paid. Interest is finance cost. It's an expense. That's why debit side. Here, asset is cash. Cash is asset. Asset should go to the debit side if it's increasing, but here it's decreasing. That's why it goes to the credit side. Okay, and if NCL is unpaid, we do it on the credit side. Got it? Now dividends, if it is ordinary one, we can give it twice. One is the interim dividend, one is the final dividend. But if it is preference shares that we are talking about, we'll have to pay a fixed percentage. It's mandatory. Okay, this is an important topic, guys. This is how the statement of changes in equity looks like. Okay, so within this itself, you can do some calculation. For example, sometimes they'll give you opening retained earnings, they'll give you closing retained earnings. Okay, and they'll ask you how much is the dividend that you're paying. How will you do that? Opening retained earnings, you can see here. Okay, then we have net profit. Net profit also should be added if they give it in the question, otherwise never mind. Then we have dividends paid. This we need to figure out. So basically we have this one, we have this one, we have this one. This should be tested. For that you need to know this format. Okay, similarly with any of these three they can do. Okay, that's why it's important for you to know. Now income tax, we already learned about sales tax. Income tax is simpler than sales tax, okay? For any business that you're making profit, you will have to pay tax. Got it? This is how you do. So tax charge even in SOPL's profit and loss account and in SOFP balance sheet, nothing but financial position, both the places you need to show how much tax you have. Okay. Now, usually tax is always an estimate. You do not know how much you're going to incur until the next year. Okay. So this year got over, but you do not know how much tax yet. Okay. Because we didn't finish the financial statements yet. Okay. So that's why we estimate a tax. Estimated tax, let's say, is 100, but the actual tax when it comes up is 120. We have kept a provision aside for 100, but then final amount comes to 120. So this extra 20 we need to pay, right? Because actual is 120. We only kept aside 100. So when actual is more than estimated, we have provided less. It is called under provision. And in such a scenario, what happens is current year's tax expense increases because this extra 20 we need to pay now. Let's go to the exact opposite scenario. Okay. Let me take it here. So now in this scenario, estimated is 120. We thought it's going to be 120, but it was only 100. Okay. So this is extra 20 remaining, right? You don't have to pay this 20. So that's why we have provided more than necessary. Necessary was 100, but then we provided 120. So more than what was necessary we provided. Then what happens is this year's current tax expense will be reduced. So how much ever you need to pay, let's say you have to pay 200 this year, then you don't have to pay this extra 20. 180 is what you need to pay. That way you'll get a refund. Got it? That is over provision and under provision. Okay. So in SOFP, you should always know, in SOFP, which is nothing but balance sheet, here you will only take the liability which is estimated amount. So in this scenario, what was estimated? 100. 100 you will be taking here in SOFP, and in this scenario 120 you will be taking in SOFP. But in SOPL you take the estimate, which is this one, and you also adjust for under provision and over provision. Got it? If you have any doubts, obviously you can ask me. Okay, before the exam, before the live gets over, that is, because after the live gets over you cannot ask it anymore. Okay. Right, so the next chapter is reconciliation. Here we'll be dealing with two types of reconciliation. One is bank reconciliation statement and one is supplier statement reconciliation. So one, we'll be looking at whether bank has done it properly, and two, we'll be looking at whether supplier statements are right. Okay, now under bank, we're always going to assume that bank is right. Okay, so we'll have to compare two things. Whenever we're looking at bank, let's just focus on bank for now. There are two things, right? One is the cash ledger, that company, cash or bank ledger that the business has. Okay, and the other one is bank statement that the bank prepares. Okay, so we will be making this manually. Bank will be preparing this. Okay, so at the end of the period we need to compare whether both of it tallies, because ideally it has to tally. If something is not tallying, then something is wrong. We need to figure out what that is. Okay, but we need always make sure that bank is always gonna be right. It is you who is wrong. That is what we believe here. Okay, so if it doesn't tally, then it is not bank's fault. You might not have included something. Now, even though same transactions are happening, why could it change? Why will it change even if same transactions are happening? Because reversal of debit and credit entry. Timing differences are the main thing here. Okay, for example, in our account, we want to make a payment to the supplier. Okay, so we have already said from our account minus $100 going out. Okay, but bank will check our account and then they'll get to know that there is no money only for it to go out. Okay, so our bank balance is at 0. Now it cannot go out, right? Correct. So what bank will do is it will bounce the check. So we will not get to know that the check is bounced. We will have assumed that 100 is already gone out of the business. Okay, but from bank's perspective, this 100 has not yet gone. Correct. So this is where a difference is happening. Can you see here minus 100 is included, but in the other place minus 100 is not included. That is when there is a timing difference happening. Similarly, let's say we have to get something from the supplier. Okay. Supplier told, yeah, we paid it. So we are already assuming that 100 is there. But from supplier's account, there is no $100 in his account. So the check will get bounced. So bank will know that money hasn't come in your business. But you in your delusional thoughts are thinking that yes, money has come into my business. So that is what timing differences mean. Okay, other things are fine. Right. Now, we got to know something is wrong, right? We need to make necessary adjustments to make it right. That is all we need to do. Got it? Right. Next one. So if there's any error or anything, you will have to correct it. That's it. Okay. So these are the two special cases that we'll be talking about. Outstanding checks and outstanding lodgements. Outstanding checks are what we have already paid. Okay. And outstanding lodgements are entity has recorded the deposit. We are receiving the money. Okay, so the customer told we have already paid you. Now we also without even checking it, we are like okay, fine, you have paid it. So that is outstanding lodgement. Bank has not processed it yet. So because of the timing difference, it will take some time for bank to clear the check, look at the lodgements, etc. Okay, so that's why the extra timing differences come. Okay, so that is bank statement reconciliation. You will have to do sums based on it. Okay, and supplier statement reconciliation is something similar that we are doing with bank. But then instead of bank statement, here supplier will give their statement. Remember, we learned it in the first chapter. I told you we have this topic later. That one we'll compare with our sales or supplier book. Okay, guys. Okay, in this scenario, what happens is here supply is not always right. We will have to check whether the supplier is right or we are right. Okay, and accordingly, whoever is right, they will stay at their pace and the other person will make a change. Got it, guys? Okay. For this also, why can there be discrepancy? Maybe supply payments are not there in supplier statement, but entity has already paid. Supplier has not updated it. We have already paid. Okay, but supplier, he took the money and he forgot to update it in his account. Then it's stupid of him. He needs to change. Okay. Invoice are not recorded in ledger. So now suppliers already sent the invoice. Okay. Supplier told, see, pay so much. But we forgot to pay because we kept that invoice in our pocket or somewhere and we've forgotten about it. So then it's our fault. We need to make the change as soon as we pay the money. Okay. Discounts are not matched and maybe errors in monetary value. It's supposed to be 100, but we put as 1000 or something like that. These small mistakes, that's it. How do you investigate it? Each line you will compare with the supplier's ledger. Okay, payables ledger, supplier statement, and then you will identify where the discrepancy is. If it is a supplier's records, you contact the supplier and be like, please change it. Okay, please do your job properly, like that. And if it's entities books, then we'll apologize for our mistake and then we will make the correct journal entries. With this, we are done with that chapter. Next, chapter number 14. Trial balance, errors and suspense accounts. What is trial balance? Trial balance is the next step after you make the ledgers. Okay, so we'll take it out. We'll look at all the debit balances, credit balances. We'll put it in one particular sheet so that it tallies. Right. So this has to be arithmetically accurate. That means we cannot put in wrong values here. Now, trial balance has to tally. If it is not tallying, there is some problem in it. Okay, but even when trial balance tallies, there could be certain errors there. Okay, so now errors can be of two types. One, where trial balance still balances, tallies, where trial balance does not balance. Now this is very simple. Maybe you just put one side. For example, debit cash is coming in, credit, let's say receivables. Okay, receivables and asset is reducing, so cash is coming. This is when money is coming in for receivables, right? Now, instead of putting it in the credit account as well, we have only taken it in the debit account. Then only one side will match, then only one side will show the money. Obviously, it will not match. So that is called single-sided entries. Unequal debit and credit. Now, the same thing will do, but amount, let's say this will put 10, this will put 12. Unequal amounts will make it not tally, obviously. Misstating account balances, incorrectly calculating or recording an account balance. So it wasn't necessary to do this particular adjustment, but we still stupidly did it. Then obviously it is not tally. Omitting a balance, leaving out a balance when preparing. So maybe this account was needed, but we have completely ignored it from the transaction. Then obviously it will not tally. Okay, everything should tally basically. Oh my god, this is not, yeah, okay. So whenever trial balance does not tally, just for the timing to make it tally, we'll create something called suspense account. For example, we have debit side, we have credit side. Debit side is 1000, credit side is 980. Now there's a difference of 20 in credit account, that we will add it in the credit account, and then we'll call it suspense account. So until we figure out what that is, this is going to be our bowl to keep it in. Okay, that's suspense account. It's a temporary account. It ensures that total debits and total credit match until the actual error is figured out. Okay, now this is where you can get MCQ questions. Even though trial balance is still balancing, why do you think it is wrong? Is going to be the question. Okay, so now they'll give you options for that. You need to be very smart to figure it out quickly. Okay, error of omission. What is the meaning of omission? This whole thing, let's say, where did that go? Debit. Okay, again, debit cash, credit receivables. Okay, the whole amount, let's say it's 100 here it is shown. Okay, so this 100 is completely ignored, so it is not there in the debit side, not there in the credit side also. So both the sides it's not there. Then it makes sense, right? You know, we are not it's getting tallied because both the sides transaction is not happening at all. That is error of omission. Then we have error of commission. What is error of commission? Here we'll show it in the wrong accounts. For example, debit cash 100, and instead of credit receivables, we'll do credit payables 100. Now that's obviously wrong. Again, it will not get tallied. Okay. Error of principle is it breaches the accounting principle itself. For example, NCA is there of 10,000. Okay. Instead of putting it under NCA, we are taking it as an expense of 10,000. So whenever we're purchasing an asset, like I told you guys, it will not be it will not be revenue expenditure. Revenue expenditure is an expense. It will be a capital expenditure. What is capital expenditure? Something that gives us value basically in the business. So if you're purchasing something, it will go in NCA account, not in expense account. And if you do something wrong, then it is error of principle. Compensating error is like this. One side you put in 100 for some reason, and the other side also just coincidentally it happens to be this thing. So one side is overstated, this also gets overstated, it will get compensated that way. It's totally out of coincidence, this one. Error of original entry is something like this. It was supposed to be 985, but you put in 895 just because of small manual errors. Okay. Now, reversal of entries, the correct accounts are used, but debit and credits are reversed. So for example, here it is debit cash, credit receivables, right? So write the opposite of it. Debit receivables, credit cash we'll do. So that is wrong. Temporary account, like suspense account, like I told you, temporary accounts to balance the trial balance. It is cleared once error is identified. So I hope this was a very simple chapter. It was just a one-pager. There's nothing more to see except for these trial balances and what suspense account actually means. Next, chapter number 15. From this particular chapter is all gonna be about the statements. Okay, so see, according to IAS 1, these are the 5 financial statements that a company deals with. Okay, these are the 5 statements that the company deals with, right? So these disclosure notes, there is no fixed format for it. We do not need to care about that a lot. Okay, but the remaining 4 we need to understand. Okay, so out of this, most of the part of SOFP we've already gone through. SOPL also we've gone through. SOCIE, I showed you that, right? The share capital, share premium, reserve, revaluation surplus, and retained earnings. These 4 things are a part of SOCIE. And the last one, cash flows, is going to be the next chapter. We'll read through that. Okay. How do you prepare financial statements? First, you record it in ledger account. Then you balance it. And then you create trial balance. And then the final year adjustments. There are a few adjustments that we'll be learning here. So those standards we'll go through. Right. Statement of financial position. Now we have non-current assets, we have current assets, that will give us total assets. Now this total asset should match with total equity and liability. How will you do that? non-current liability, current liability, and equity. Okay, you can take a minute to look at this. Okay. Right, next is SOCIE, changes in equity, which we've already gone through in the previous chapter, so I hope this is fine for you. Right, statement of profit and loss and OCI. Remember when I told you about OCI, I told you revaluation, that comes here. Okay, there's revenue and cost of sales. I told you within cost of sales itself there's a formula, opening inventory plus purchases minus closing inventory, that gives you cost of sales. After that, revenue minus cost of sales gives gross profit, minus all these extra costs will give you operating profit, plus investment income minus finance cost will give you profit before tax, and then after you pay the tax you'll get the net profit for the year. Got it? This is an important format. Okay, so we've gone through all financial positions, profit and loss, and SOCI. The only remaining thing is cash flows, which comes in the next chapter. Okay, but here before we go to that one, we have two standards that we need to deal with, IAS 10 and IFRS 15. Okay, so IAS 10 will be dealing with two things. One is adjusting events, one is non-adjusting events. What is IAS 10? IAS 10 is events after reporting period. What is that? It defines events after reporting period as events which is both favorable and unfavorable that happens between the reporting date and financial year. So it's like this. 31st December, let's say, is the reporting date, year end for the company, right? So from 1st Jan to 31st December, it prepares the financial statements. Now, after all this happens, there should be still like, a span of 10-15 days. Let's just assume it to be 15th Jan. During this time, they will take some time to review the financial statements and see if you can authorize it to go to the audit and then issue, etc. Right? So during this particular time between the reporting period, which is this one reporting date, and when they authorize the statements for issue, during this particular scenario, whatever happens, that will come under reporting period. Now this can either be favorable for you or it can be unfavorable for you. We don't care, we just need to include and incorporate that. So that can be of two types. One is adjusting events and one is non-adjusting events. Okay, adjusting events provides evidence of conditions that existed in the reporting period. So during the reporting period only, during 31st December, you would have known that this can be stopped, this can happen. So if there is a scenario where it shows that in the reporting date itself this was a part of it, you will include it as adjusting events. Okay, any adjusting events, you will come back and adjust it in your financial statements. Got it? If it is non-adjusting events, that means on the reporting date on 31st December, you did not know that this could happen. Okay, so that is something like after 31st December, let's say on 5th Jan or something, there's a tsunami. Okay, there's a flood or tsunami or whatever. You could not have predicted that, correct? So that becomes non-adjusting event. Got it? Whenever there is a non-adjusting event, what do? You cannot do anything. You do not have to adjust your financial statements. But if it is a big amount, if it's a material amount, you will show it in your notes. That's it. Got it? So these are the few examples of what adjusting events could be. You can have a look at it. And these are few examples of non-adjusting events. Okay, only I'm telling you again, only if non-adjusting events are material, that's when you will show it in notes. Otherwise you will ignore that event completely. But adjusting events you will show even if it is immaterial or material. You need to go back and adjust the statements. Okay, with this we are done with IAS 10. Next, IFRS 15 is revenue from contract with customers. What is revenue from contract with customers? It is like the normal revenue that you're making. So ordinary business is happening, buying, selling, that's happening, right? When you're selling, you will get certain revenue. That is revenue. Okay, this does not include sales tax or amount collected on behalf of third parties. Okay, what is the meaning of amount collected? Now this is someone, they are selling us $100 worth goods and we are selling it to someone else the same goods. So here we are not making any profit except for commission. Okay, because the profit of all this 100 goods go back to this person. The only profit we could possibly making is commission, that can be included as revenue. This 100 goods amount will not come in IFRS 15 revenue. Okay, now the 5-step revenue recognition approach. So what do you do? What is the 5 steps? First, you look at the contract. Without anything, you do not jump here and there. First, you will look at the contract. Okay, after you see the contract and you're fine with the terms and conditions, that's when you will get into the contract. Okay, now basically it's like this. So in the contract, you will see all the terms and conditions, you will see what should be done, you will see this, that, you will see, and then that will create a right and obligation after you accept the contract. You're like, okay, fine, I accept this contract. If this happens, then you can move on to the next step, which is identifying performance obligations. For example, there's one example which is so frequently tested, so I'm just going to talk about that, right? So we'll say we are supplying a TV. Okay, TV costs 300, but then we also need to supply service for that. For 1 year, we'll give you free service. Okay, so let's just say this is free for now. Okay, TV plus service 300 together. Okay, but usually there's always a price for it. So let's not complicate the scenario. Let's tell TV is 300, service is 120. We have 2 things that we need to do in this contract. So that is step 2. You're identifying performance obligation. So you know there are 2 things, right? You need to do 300, 1 TV, and then you need to provide the service for 120. These are 2 things that you need to do. Third, you need to determine the transaction price. What is the transaction price here? 300 and 120. Then you will allocate the transaction price to both of these things. So for example, let's assume that TV service was free. Okay, now how will you allocate price to this? We will check as the individual thing. For example, service usually for 1 year costs you 120. We will use that into the amount and then we'll take. Okay, how will you do that? Although it is free, how will you do that? We'll do 300 divided by 420 into 300. So how much will it be? This is for TV, and for service will be 300 divided by 420, not 300, 120 divided by 420 into 300. I do not know how much it is. Let's use the calculator. Okay, so 300 divided by 420 into 300, which is 214.2. Okay, 214. Now for service, it's going to be 120 divided by 420 into 300, which is 85.7. So I'm going to take it as 86. Got it? So if the amount is not given, let's say even if it was free, you will look at the standalone price of it and you'll try to figure out how much part of it could you be spending on the service. And let's say service is for 12 months, right? So immediately you cannot recognize 300. Okay, every month you recognize a percentage. So if it is 86, right, for 12 months, how much will it be? So you'll have 86 divided by 12 and almost 7 point something. So I'm just gonna tell 7. So every month you will recognize $7 as your revenue. You will not recognize 86 as your total revenue in the beginning. Got it? That is allocating the transaction price. And finally, I showed you how to recognize revenue here in this scenario. For TV, immediately you can recognize this particular 214. But this 86 will be done on a going basis. That is over the period of time. TV at a point in time, you can recognize 214. This 86 you cannot recognize immediately. You'll have to recognize 7 per month. Got it? That is at a point in time and over the period. Okay. Next, chapter number 16, incomplete records. What is incomplete records? So sometimes what happens is there could be 1 or 2 things missing. Okay. So in such a scenario, what you do, you will use these small formulas. Like I was telling you about the retained earnings, no? Closing retained earnings you calculate. This is the formula. This you can even, you don't have to remember here. You can even figure it out through this particular table. You see, closing retained earnings is not given. How can you figure out what is closing retained earnings? Do this opening and then you retained earnings will not come here. Okay, retained earnings, it will only come in revaluation surplus. Net profit you will take, you will reduce the dividends and you'll get closing. Okay, and this and the same formula is mentioned here. We have opening retained earnings plus profit minus dividends. That's it. So to do anything, you have these little formulas. For example, we even learned that assets is equals to equity plus liability, correct? Now, if you have total assets and they're asking you what is retained earnings, then you can still use this particular formula and get it done. So everything has these little formulas. So this chapter is filled with those little formulas. So I think you can go through it because you will get questions from this as well. Okay, what is missing? How much is the amount that is missing? Like that they'll ask you. Also for receivables, you can do opening balance plus sales minus receipts, which will give you closing balance. For payables, same thing. Okay, so these little things you can go through it. So chapter 16, you can go through it, guys. It's not a big confusing chapter that we need to deal with. I went through all the basics that I needed to, so remaining is fine. Chapter number 70. This is a very important chapter. Okay, why is it important? Because you will get a for sure question from this chapter. Okay, so it's going to be one of your section B's. Got it? So section B's are usually, they'll give you a question, they'll give you something like this, a table, and then you'll need to fill in these. Certain blanks will be given, you will need to fill in those blanks. That's the kind of question they will ask you for cash flows. Got it? Now, to understand cash flows, this is the format, by the way. First, just look at the format. We'll go through it first. So we have operating activities first. Okay. Under operating activities, we will start with cash generated from operations. Okay. Interest paid, income tax paid, will reduce it, and then you will get cash flow from operating activities. Okay. Cash flow from investing activities is anything that you're getting money for when you're selling, or you're paying money for when you're purchasing. Okay, like PPE, when you're selling any equipment, anything like that. Okay. For financing activities, it is issue of shares. Whenever you're issuing shares, whenever you're borrowing, etc., money comes in, right? To pay dividends, money goes out. To pay interest for loans, money goes out. All these things come under financing. Okay. Now, guys, to get this cash generated from operating activities, there are two methods. Okay, one is direct method and one is indirect method. Direct method is very simple. Day to day you will have bills, correct? Cash outflow, cash inflow, that you'll just add and subtract those bills. That will give you direct method. Now it's very easy for us because all the positives and negatives we have, you just need to add and subtract. But for the company, it's very hard because you cannot keep a track of each little thing. Okay, so that's why they usually opt for indirect method. What is indirect method? They get the profit before tax. Profit before tax, you're anyway getting to create the profit and loss account, right? SOPL. From this profit and loss account, they add or reduce the non-cash expense, working capital, etc. That is indirect method. Got it? So, you can go through this once, we'll read through it. Profit is calculated on accrual basis and may not reflect the actual cash. Non-cash items can be there, credit sales can be there, which can distort the picture. Okay, but that's why we need cash flow management, right? So why do we need cash flows? These are the things that you just need to go through. We cannot like it's just basic understanding. So why do we need cash flow? Because we need to understand what are the cash flows, inflows, outflows happening, so that we can compare across entities. Benefits is you can assess how much liquidity we have. We can distinguish between operating, investing, and financing. These are the three cash flows. Okay, operating activities, investing activities, and financing activities. Coming to drawbacks, it deals with historical data. That's why it's not forward looking. It is of limited use. Okay, so like you'll have the previous historical information, but what are you going to do about it? You cannot do anything. You need forward looking information. It excludes non-cash transaction. Okay, right? So now operating activities, like I told you, there are two methods, direct and indirect. You adjust PBT for non-cash transaction. Here actual receipts minus actual payments. Got it? Indirect activities, acquisition or disposal of long-term assets. Cash outflows will be like purchase of PPE, long-term investment, etc. What we looked at here basically. Okay. Now, when we look at financing, sometimes financing activities takes you to a negative balance. This necessarily is not needed to be a negative thing, because whenever it shows negative, that means you've paid your debt or something. That also could be a reason, right? But when we look at positive, that means when money is coming in. How is it coming in? Through external source of finance. Could be share issue, it could be loans, anything, right? So positive is not always a good sign here, is what I'm trying to tell you. Got it? Now, coming to chapter 18, last 3 chapters remaining. 18 chapters all about ratios. Everything about ratios, nothing else. If they ask you question solving based on ratios, this is your chapter for it. Okay. Chapter 18, interpretation of financial statements. Okay. These are the key ratios we'll be dealing with: profitability, liquidity, efficiency, stability ratio, etc. Okay. These are the ratios that we will be mainly concerned with. Got it? Now, there is nothing to explain in these ratios. Everything I've given here, see. So for gross profit margin, it's gross profit by revenue into 100. What does it show? How much percentage of your revenue? How much is your revenue more than cost of sales, to just show the profitability. If it is high, that means you have more control over production. If it is low, that means your cost of goods are rising, like that. Okay. It's influenced by selling price, blah, blah, blah. Oh my god, all this will not be asked, is just for your understanding. Just look at the ratios and understand what the increase or decrease means. That's it. Understand, remember the formula, what is the increase showing and what is the decrease showing. For operating profit margin, operating profit divided by revenue into 100, what does it show? How profitable the company is after deducting all the operating expenses. What is a high margin? Shows cost management. Low margin shows high operating cost. That's ROC. This is a formula. Okay. What does it measure? How effectively a company, this is important, how effectively a company uses its capital to generate profits. We're just skimming through this. We cannot do much about ratios other than by hearting the ratios, and then just understand what high and low means. High ROC means what? Efficient use of capital. Low ROC is underperformance or inefficient use of capital. So this is what we'll be dealing with in profitability ratios. That was done. Next, we are dealing with efficiency ratios. Efficiency ratios has net assets turnover, inventory turnover period, all these receivable dates, payable days, etc. Okay. Inventory turnover, no. Net assets turnover is revenue by net assets. Remember the formula, guys. Okay. What does it measure? The efficiency with which business uses its net assets to generate sales. Got it? The students will, if you ask for it, I will send you these notes. Okay. Whoever is enrolled in F3. High turnover indicates effective utilization of assets. Low turnover may reflect underutilization. Inventory turnover, inventory by cost of goods sold into 365. What does it measure? The average number of days inventory is held before being sold. Okay. If it's a short period, efficient management. If it is long period, overstocking, slow sales, whatever. Okay. Receivables period, trade receivables by credit sales into 365. What does this mean? How much time does a customer take to pay? Okay. If it's a short period, it's good. We're managing the credit well. If it's a long period, that means it is weak collection policies. We need to do something about it. Okay. Next, payables period shows how long are we taking to pay to the suppliers. If it's a short period, this means we are paying them faster and maintaining some good relationship with supplier. But if it's a long period, at the same time, it shows that liquidity issue is there. I mean, yeah, we are not paying for a long time. That means we are also using the money effectively. We can say we are using the same payables elsewhere and making revenue. That could be one reason. Or maybe we just don't have money to pay them. That could be liquidity problems. Okay. Next, current ratios, current assets by current liabilities. Ideally, you need to have it at 2:1, but nowadays 1.5 is also fine. Okay. Because if it's too high, then it is strong liquidity, but then we are not using the resources sufficiently. We can use it to make more profit, but we're not doing it. We are stupid at that way. Okay. Low ratio means liquidity issues. Quick ratio is the same current ratio, current assets minus inventory, but here. Okay. So the ability to meet short-term assets without relying on inventory. Okay. High ratio means strong liquidity. Low ratio means possible short-term stress, financial stress. Cash conversion days. This is the formula for cash conversion days. inventory days plus receivables minus payables. Okay, this is the time that it takes for the company to convert investments in inventory and receivables back into cash. So we have invested certain money in inventory. After we sell it, we are investing it in receivables. Finally, how much time does it take to get back the money? Okay, how much time? Next, gearing ratio, you can calculate it in two ways. One is debt by equity, one is debt by debt plus equity. They will mention in the question whichever they want you to do. Okay, if it's high, that means more financial risk, but also you could get higher returns. Low gearing means conservative financing and reduced risk. Interest cover, how much profit are you making to pay the interest? For example, the profit for the year is 100, interest payable is 20. So with this particular 100, 5 times you can pay your interest. That is what it shows. Do you have the ability to meet your interest is what it shows. If it's a high cover, then strong ability. If it is low cover, then it is weak solvency. Okay, so now I will show you the whole table. That way you can, if you want, you can take a picture of this right now. This shows the total thing in one look. Okay, so this is enough for you to look at ratios, because ratios is just going to be solving. You do not have to sit and type and explain everything, which you will have to do in the next paper, which is financial reporting. But for now, this is sufficient. Okay, took a picture. Next, last page. It's just a 2-page thing. I hope you can go through it. Okay. Next, last 2 chapters left. Both of it is about consolidation. Okay, consolidation is actually a very easy chapter. You just have to remember a few working notes. Okay, with this, consolidation will be done. So both the chapters will go through it together, right? So first, what is a group? Group is something that consists of parent and subsidiary. When can you have a subsidiary? When you can control more than 50% of the company. Okay, and also along with that, you should have power over the investee. You should have the rights to get all the returns that they are getting, and you should have the power to affect the returns. Okay, right. So how are you consolidating it? We have, this is not necessary, just the 5 working notes is very important, because in your section B you will be asked, like, solve it according to second working note, solve it according to third working note, and you need to know which working note is what to solve this type of question. Okay, so group 1, for the first working note, there's nothing much. You're just telling how much percentage of the company is held by the parent and how much is held by the other party, which is known as non-controlling interest, NCI. Okay, so also along with that, you will mention which day did you acquire the party for, which day did you acquire the subsidiary for. Okay, next, second one is net assets of subsidiary. For this is the working note at acquisition, at reporting, and post acquisition. You will get the total of this. This particular total will be used in third step also here. This is the same thing. And this total will be divided between parent and will be divided with NCI. Okay, the percentage. Let's say 80% is held by parent, 20% is NCI. So the 80% of this amount will go to working note 5 here, this one. Okay, and the 20% of this working note will go to working note 4 here. Got it? And then we'll go to third step, which is goodwill calculation. Goodwill arises when the acquisition cost exceeds the fair value of net assets. It represents intangible benefits. Okay, it's recognized as intangible asset. Okay, it's recognized as an intangible asset. Good, that's it. So this you will, so under your net assets, under your assets, basically you will have investment written. You will take out this investment and you will write goodwill there. Okay, next, for working note 4, this NCI will come under equity in your SOFP balance sheet. This also SOFP balance sheet. Okay, retained earnings, then retained earnings will also come under equity under balance sheet, SOFP. Got it? Also remember, if there is any receivables or payables, you will subtract it. You will take it out from the balance sheet. If there's any dividend, you will not include that because that is internal transaction. Internal transactions are always eliminated. Unrealized profit, if there is, what do? It arises from intra-group sales. Now, what is an unrealized profit? For example, this is the parent. This is the subsidiary. Okay, parent sold $100 worth goods to subsidiary. Okay, now out of this, subsidiary should sell it to someone else. Subsidiary should sell it to its customer. He sold $90 worth goods, right? Now let's say the profit margin that they can incur based on this is 10%. So now how much is the goods not sold? This remaining 10 is not actually sold, correct? He sold it to subsidiary. That is an intra-group transaction. We can eliminate it. The remaining money, that is this $10, hasn't gone out of the business. It is still within the business. We cannot include profit for it, correct? So for this one, the profit margin is 10%. So you will reduce this profit margin. So 10 into 10%. 1 should be reduced from your cost of sales. Okay, that is unrealized profit. It should be eliminated because group cannot profit from itself. It should be removed to avoid overstating it. Okay, intra-group receivables and payables, we have already mentioned, that should be eliminated. So for PUP, which I just did, okay, see what they're doing, determine the closing inventory. What's the closing inventory? 90. It was 100, but now it is 90. Okay, identify the profit element, which is 10 here. Okay, now it's based on the seller. If parent is the seller, then profit will be the PUP will be reduced from this working note 5, PUP minus. Okay, but if subsidiary is the seller, then it will be reduced here. So PUP, and then you will take the amount here. It will be taken under both parent's account and NCI's account. Got it? The final chapter is consolidation. Consolidation of consolidated statement of profit and loss. It aligns with the same principles as SOFP. Okay, here you just need to do one extra thing. Everything else is the same. Just this NCI profit. So for example, we get the net profit at, let's say, $100. Now this $100 you need to divide it amongst both parent and NCI. So what do? NCI into parents subsidiaries profit after tax, not the whole company's profit after tax, only the subsidiary. This net profit of 100 includes both parents, let's say 90, and subsidiaries 10, correct? Only the subsidiaries 10 you will take, and let's say 20% of it is with NCI, then you'll just take this. 2 is gonna be the profit of NCI. The remaining 100 minus 2, 98 is gonna be the profit of parent. This is what the calculation is. And also along with that, the PUP adjustment that we dealt with in the previous one, that also you will be reducing here. Got it? The profit will be split between parent and NCI. But I'm telling you again, guys, NCI will only get the percentage of profit from subsidiaries net profit, not the total net profit, not this. Okay, but subsidiaries 10. Okay, intra-group you eliminate, mid-year acquisitions, yes. So if subsidiaries acquired so year starts from Jan 1st to December 31st. If a subsidiary is acquired in September 1st or something, so you will only consolidate the figures for September, October, November and December, 4 months. The remaining 8 months, you will not consider the subsidiary in the business. Okay. Finally, accounting for associates and joint ventures, which is IAS 28. It's not a very big topic in FA. Okay. Right. So for associates, we account using this method called equity accounting. What is associate? Associate is you do not have more than 50% of the control of the company, but you have 20 to 50%. More than 20, less than 50. Then you cannot control it, but you will have certain influence on the company. So that's called significant influence. Okay, within the company you will have. Right. Now we have equity accounting. How do we do this? First we recorded cost, and then later you will look at the subsidiaries profit or losses. Now see, in SOFP what you do is you will take 100% of the assets and liabilities of subsidiary, but for associate you only include it under your non-current assets as investment. That's it. You do not take the whole consolidation of subsidiary of associate and put it here. You do not consolidate it. For SOPL, parent and subsidiary, again 100% you consolidate it. But for associate, it's a one line item telling how much profit. So if the subsidiary associate has given 100 profit, right? But we own only 30% of the company. 30 is what you can include as share of profit from associate. That's it, after tax. Okay. Okay, now this one, investment in associate that I was talking about under net non current assets, how can you calculate that? Using this one, cost of investment. Let's say we spent 1000 to get that 30% share in the company. Okay, share of acquisition profit, how much profit did we get? 30. That we will add. Do we have any impairment? We are assuming there is no impairment. Do we have any profit provision on unrealized profit? We are assuming there is no PUP. So our amount should be 1030. This 1030 will go here, but only 30 will come here. Got it? Okay. Now let's say it is neither a subsidiary nor an associate. What do? You're just investing in a company. Let's say you have 9% or 10% of the shares of that company. You do not have a significant influence. You do not control the entity either. Then what you do is you treat it as a simple investment. How do you treat it as a simple investment? You just take it as investment under your NCA, non-current assets. You do not consolidate the amounts. Again, obviously associate you didn't consolidate. This also there is no chance you consolidate because this is only 9 to 10% of the amount. Got it? Now, dividends received appear in profit or loss. If there is any dividend received at all from this 9 to 10% of the investment that we hold in the company, then it will come under SOPL. Got it? That's it. With this, we are done with financial accounting. But let me tell you how the section's gonna be. We have section A and section B. Okay. How do we answer this? 2 hours paper. Okay. So for section A, we have two marker questions. This could include calculation. This could include theory. This could include journals. Anything. Right? It could include any of these topics. Anything from these 20 chapters can come in section A. Okay. 2 marker only. One question each. 2 marks. Very simple. So this one you're gonna have 35 questions at 2 marks each. So you're gonna have it for 70 marks. Got it? Right. So there are only 2 questions from section B. This is 35 questions. Here only 2 questions, and each question will be for 15 mark. Got it? 30 marks from section B is what you will get, right? But obviously this whole 15 mark like that is not gonna come. You will be divided into, the question will be divided into tasks. Each task will be worth 2 marks, 4 marks, 3 marks, anything. They can divide it, right? So a cash flow statement, if it comes, it can come for 10 marks, 12 marks, so that huge amounts, right? But other things, they're going to divide it in tasks for you, right? Now, this section B can include topics from preparation of financial statements for which you need to know the statements. IAS 1 that we went through. So there are 5. One is the notes, SOPL, okay, SOFP, SOCIE, and SOCF. What does it mean? Statement of profit or loss. Statement of financial position is nothing but the balance sheet. Equity changes, okay, cash flows, and notes we do not have to remember much, right? So this is gonna come from one question for section, right? That's one type of question that could come. Second could be the interpretation. What is interpretation? Probably asking for ratios and asking what each ratio means, etc. This is going to be a simple question because you will not have to sit and type anything, right? And the final one is going to be from consolidation, which we dealt with in the last 2 chapters. Okay. For this, I cannot signify how important it is for you to work on your working notes. Working notes are going to be there for both SOPL consolidated and SOC what is this? SOFP both consolidated. Okay, working notes will be there and you will need to solve questions. Right, understood? Interpretations will mostly not come. Okay, but cash flows, it's very important. Cash flows, right? Interpretations could come, but so far it hasn't come, so let's not talk about that, right? So we have preparation of financial statement, which includes all the four, along with which cash flows will have separate relevance because there's high chance of one of the cash flow question at least coming, right? So you can look at the preparation of statements and consolidation. These are two main topics. If you can learn these two properly, 30 marks goes into your pocket. Okay, so with this, I think we are done with all the portions. And I've also told you what could come for section A and B. So other than that, if you have any doubts, you can send a comment on this itself. Okay, we will see. If it's a big doubt, then probably I'll come live and then I'll teach you again. Okay, not a big deal, right? So thank you guys, thank you very much for joining. I hope you understood. I hope it was easy for you. Okay.